I'm Todd Phillips. I'm a former attorney, CPA, real estate developer. I've been with RE Journals now 5.5 years. I came on board when my business partner, Jeff Johnson, asked me to help him grow the company. So we now have 8 publications across 17 states, and we do about 200 events a year across the country. I am our webinar host in addition to being our CFO. So I wear a lot of hats, do a lot of things. Try to be a technology guy, although I'm falling behind on that the older I get. My co-host today, Steve Bloom, Ren TV, has a fantastic website. I'm going to show it to you halfway through. This is the YouTube of our commercial real estate industry. This video in complete form will be on that, and you can rewatch this if you missed anything, or if you want to send it to a friend because you found some great information. Steve, you want to introduce yourself real quick, and then we'll go to Jay.
Yeah, thanks, Todd, and welcome everybody. Appreciate being here. And just for those who aren't familiar with Rent TV and me, I come from the real estate industry. I was actually a broker with Cushman & Wakefield in Los Angeles, originally from New York City, where I worked for developers back there, and launched Rent TV 23 years ago. We have the website, our news media coverage of the left half of the country. So it's great to be working with Todd throughout the Midwest to really build a national audience for what we're doing together. And so we have renttv.com, we own sublease.com, and as Todd mentioned, we launched a new video platform called The Review for videos for the commercial real estate industry, which we'll show you in a little bit. And with that, we'll start the program.
Let's dig in. We've already burned 3 minutes worth of content. So Jay, you're here to kick us off. CoStar is the crowned king of data and information for our real estate sector. So we hope that you could kind of set the stage for us today. What is the demand for this build to rent product like? What is driving this brand new, well, it's not brand new to some of these folks, but for a lot of people, it's just catching their attention. What is driving this industry? I'm going to let you take it from there.
Yeah, I think what's really driving this industry is there's been a definite shift in demand for rental properties in the United States. And when I say rental properties, I mean all types, single family homes, small multifamily properties, and of course, and traditional apartment buildings. So, coming out of the Great Recession, when you look at the data in terms of absorption in the multifamily space, we saw absorption really accelerate coming out of the Great Recession. We saw demand for single family homes accelerate dramatically coming out of the Great Recession. And I think these are all indicators of that shifting outward of demand for rentals. And so I think that that's part of what's going on here. And as you kind of alluded to, I mean, single family has always been a piece of the rental pie. I always kind of think of it in terms of like 3 slices, about a third. So there's currently about 45 million renter households in the United States. So I try to think about it in terms of thirds. So about a third of that rent in single family homes, a third rent in larger institutional type multifamily properties, and then a third rent in smaller buildings or duplex types of properties. So that's that's kind of the whole rental space, and I think that demand has been increased across the board. So single family rental has definitely seen a lot more demand, and that's spurred on people to start building in the space a little bit more to try to take advantage of that demand.
What I was just putting on the screen for B-roll there. So those of you that are new to the format, I went to the left of your screen. If you're looking at me right now, I went to this side, I believe, clicked on speakers, and that lets me see the bio of each of the speakers. I found Jay's name. I clicked on that. I can find out a little more information about it. So that's there for your convenience. All of our speakers for the whole day are in that spot. So Jay, I had heard, well, let's just talk about the interest rates, because I think that's probably the elephant in the room. How is that going to affect landlords, renters, and home buyers? I mean, home sales are falling apart across the country.
Yeah, the single family market has been very interesting the last few years, as we've seen inventory is at all-time lows, and prices were up dramatically. We saw a huge run up in prices, obviously in 2021, due to the incredibly high demand and low inventory. I think that the higher interest rates are going to take a little bite out of that demand. But what I think is interesting and something that gets kind of lost sometimes, when the 30-year fixed rate goes up, a lot of home buyers shift to ARMs. So it's not as dramatic of an increase as the press likes to make things sound. So that's one thing. In terms of the investor side of the business and the impact that that's having, obviously the cost for debt has gone up, and I think that a lot of smaller private equity that's been looking in the space to invest is now kind of now sitting on the bench. And I think that what we're seeing is that it's really the more very well established and deep pocketed investors that are able to really come to the table a little better. But the question of yields and the question of cap rates rising is on everyone's mind. I get that question pretty much every day, and it's not an easy one to answer because for 7 years now, everyone's been saying that interest rates are going to go up, and that cap rates are going to go up. And every year I've said that, I've been wrong. So I've almost stopped trying to even predict anything, because I with that kind of track record, I think I'm missing something. But in terms of inflation's impact on operations, there's no doubt that expenses at the property level are rising across the board for all types of services, all types of materials, etc. So that's definitely affecting NOIs right now. And we're in an interesting situation right now where the historic rent growth that we saw last year is tempering. And not that that's a bad thing, because double-digit rent growth is just unsustainable at any level. But I think that the issue to me that's going to happen at the property level is that, I'm not sure how much more that landlords across the spectrum can continue to raise rents for the most part and have the residents be able to absorb those increases. At the luxury apartment level, that's not a problem, because those residents spend the least amount of their income on rent, so that they're able to absorb those increases more. But for households that are, maybe in the Class B space, in the single family home space, in which they're spending more of their income on their monthly rent, I think that this is setting up a really it's going to be a tough situation on both ends of the table, because the landlords are going to be wanting to try to increase their costs. The residents are already having a tough time paying. So it's a really tough dynamic that we've got kind of set up right now. And as the renters are also paying significantly more across the board for everything. So it's not going to be an easy battle. And right now, I think that the renters are starting to get a little bit more power, because we've been seeing demand starting to temper a little bit right now. So I think that's kind of the situation that we're looking at today.
So I do want to have a follow-up question to that. Just that last bit about rent, maybe demand's waning a little bit. Is that across the board? Is that in certain states? Because there's been some dramatic increases in rents outside of my home state, which I wish it would go up here.
Yeah, Jay, I wanted to add on that too, throw that layer. Is it urban versus suburban as well, to throw that layer on that?
No, actually, we actually saw a really good bounce back in urban locations last year. I did a study of looking at 14 major downtown submarkets across the United States. I excluded New York City because New York City's its really own beast. But, I looked at, major cities, Boston, Atlanta, Denver, Dallas, LA, etc. And what we saw was that last year, those 14 downtown submarkets that I examined saw asking rents increase 14.3%. So, and we also saw a huge bounce back in absorption in those downtowns. So it's not really a question of urban versus suburban anymore. Obviously, in 2020, the suburban markets performed much better than the urban markets. In those 14 urban markets in 2020, we saw asking rents decline 6%. So, we're not seeing that same dynamic. But what we saw in our second quarter absorption numbers, now this is just for traditional multifamily property that we track, and we track about 18 million multifamily units. We saw second quarter absorption of only 68,000 units. So that's definitely much lower than we were forecasting, and also much lower than we typically see in a second quarter. Second quarter typically tends to be the quarter with the most absorption. Now it's much harder to know what's going on the single family side because we're trying to build up our single family data presence right now. Where we've started to do that, put most of our focus is on the single family build to rent construction pipeline. So I don't really have the best barometer on what's happening on the single family.
How many units are you tracking there?
We are tracking about 12 to 14,000 units right now.
In the build to rent space.
In the build to rent space. And we're finding it a very, very difficult area to try to track.
Is that existing units or in the pipeline?
In the pipeline.
Yeah, we've got some guests coming up that can shed some more light on that, I believe, for you, Jay. It might be a good source of information.
And we're back to Todd's other question, then getting into the states, in the geographic areas, where is that concentrated?
Basically in the southeast and the southwest. So, Phoenix, Dallas, Denver, San Antonio, also seeing some in Atlanta, and then kind of some of the tertiary markets in the southeast. We're seeing those popping up also in Alabama, in Georgia, and then also in like South Carolina.
Gotcha. So a mix of kind of high rent growth and moderate, temperate rent growth areas.
Yeah, but I think also just regions that we saw large increases for demand for housing across the board.
Mm-hmm.
So, that to me is also then that the single family rental market is kind of acting as a little bit of an escape valve for that housing demand. So, and those markets have been, some of those markets over the last few years have seen a real tightness across the whole housing spectrum. So,
Right.
Those are, I live in Phoenix, and you definitely have, I've seen this firsthand in Phoenix in terms of just the lack of inventory of single family housing available, multifamily housing available, and, limited new construction coming online to be able to absorb the amount of demand that has been coming into the market.
Although we get more stories from Phoenix development than anything else in the country on developments in Phoenix. It swamps every place else that we cover.
As of right now, yes, it's the pendulum has really swung to the other side, especially on the multifamily side of the ledger, no doubt.
Well, we got 5 minutes. We got to focus on a couple things I got to pick your brain about, Jay. You mentioned demographic shifts. I read a statistic, and I tried like heck to find it over the weekend, that some percentage, 70% or something, of current renters said they would prefer their next rental to be a single family rental residence. And I have to assume that's because of household formation, but is it single people too? What are the demographic shifts that are sort of affecting this boom on the build to rent side.
Yeah, I would probably I would flag that comment, because one of the things that I like to talk about is household sizes and impact of household types on housing demand. So in the chart that you're showing here, the thing that this is looking at household types back from 1960. In 1960s, married couples with children were the largest household type in the United States. Well, that's shifted dramatically in the past 60 years. And today it's singles and married couples without children. And there's approximately 10 million more single people in the United States today than there are married couples with children. Well, that's a pretty dramatic change in terms of household composition and then therefore the type of housing being demanded. So when you think of multifamily rentals, singles account for the largest share of demand. So pretty much 50% of all apartments are leased by single people. Now, I had this statistic at one of my old positions, and I wasn't able to bring it with me, and I couldn't find it this weekend when I was prepping. But when it comes to single family rental, the largest household type that rent those types of properties are married couples with children or single parents with children. So my concern, I have a little bit of a concern that I think that the lack of ability of people to buy has definitely helped increase the demand on the single family rental side, because these are household types that have a strong propensity to wanting more square footage, needing space, and wanting that security that they get in terms of single family. So I think that's part of what's driving it. My concern with surveys like that is that I don't see, and this is backed up with data that you see from apartment REITs. There's very little demand of people in multifamily making the jump from renting multifamily to owning single family. And I think that is because of the household compositions. Single people just aren't that interested in going from living in an apartment building to having a house and having to cut the grass and shovel the snow and take care of all those things.
Pay the taxes.
And have 3 times the amount of square footage that they have to clean every week. So,
all right, we got 1 minute left. We can't leave without talking about the Fed. I'm sure you track them. I think personally they're completely off their rocker. I don't believe inflation is caused in large part of what they're blaming it on. I think it's all of the trillions of stimulus put in. That money's got to get burned through, and it's still hitting the market. They're still, in my home state, they're giving out the warrior pay or whatever, frontline worker pay. I mean, there are checks going out.
They're giving the gas rebate check out here in California soon.
Right. Money. It causes inflation, right, Jay? Am I wrong? Or what's going to happen when the Fed overshoots the mark? Are we in trouble?
Yeah, because I take kind of a different bead. You can trace more than half of the current inflation to the result of the war in Ukraine. So the Fed trying to raise interest rates in the United States to lower inflation doesn't change what's going on in the commodities markets for oil and for grains and for commodities that the Ukraine plays a very important role, whether that's wheat, whether that's fertilizer. So to me, the real problem is the war. And so raising interest rates here in the United States does not stop that at all. And so I'm very concerned that we could end up in a situation similar to the early 1970s, where the Fed continued to raise rates and they weren't, because they didn't quite understand what was causing the inflation.
Unfortunately, I would agree with that. We got to move on. Jay, thank you so much for your time, and CoStar for their generous hospitality, letting us have statistics and access to a world-renowned economist, and look forward to talking to you the next time we do this event. And you'll probably have more information on the pipeline we can share. That'll be exciting.
Thanks for letting me speak this morning.
Yeah, thanks, Jay. We're bringing in Mitch from True America. Mitch, if you want to jump in. you're out there.
Hey guys, how's it going?
There we go. I'm going to let you introduce yourself, talk about True America, but it's an honor to have you on this event this morning. I think you're going to have a lot of good information to share. Look forward to picking your mind.
Yeah,
Tell us about your company.
Yeah, so True America, we're the 29th largest multifamily owner in the country. So we own and operate about 60,000 apartment units across the country in about 20 plus different markets right now. And we actually, I got brought in early February to launch the Build for Rent platform for the company. That'll really, at the end of the day, look like, a development platform that will, jump back all the way to land acquisition and kind of oversee the development of build to rent communities across the country, from kind of land ac all the way through to fully operating, and kind of roll those communities into, what is, the total portfolio to date. So we have 3 deals right now in the marketplace. Totals about 1,600 units, and 1,000 which of those units are built to rent, and the remaining is actually finished lots that will sell to home builders as a for sale component to our communities.
That's an interesting dynamic, a mixed property. I had heard from lenders that, they kind of wanted one, set of property with amenities and all that stuff so they could, because I don't know if that's a Fannie Freddie requirement or if that's just most lenders, but it's neat to see that you're mixing in the for sale with the for rent. So True America was a traditional multifamily, high rise or mid rise or whatever kind of company. What prompted the jump to build to rent?
So the majority of all of our units are, value add, garden style type apartments, workforce housing. That's really the focus of the portfolio. And, as we looked at the bedroom counts across the portfolio, majority of it is made up of 1 and 2 bedroom units. And so there was kind of this natural fit to couple build to rent with it, with those communities mostly focusing on 3 and 4 bedroom houses. And so, now as we start to grow the portfolio, we look at this thing and say we can really cater to, the entire demographic of America that's seeking rentals, and build to rent as a whole, really fits into that workforce housing at its core. That's really what we're doing here, is trying to add housing stock that meets what was entry-level housing, when entry housing level actually existed. And today that's just not the case. And so we have to adapt to the marketplace, and build to rent, I think, is really filling a huge void of what that was.
I'm going to go off script a little bit here. Steve, get ready with some questions too, because I think it's
got
interesting.
A couple lined up.
There you go. What we've got a dynamic of different property types, right? So you're in a single family built to rent community. You're saying 3 to 4 bedrooms. In a for sale, maybe 3 to 4 bedrooms. Are there 1 and 2 bedrooms? Are there smaller units? And then are there smaller lots? I have to assume, I read somewhere 9 to 11 units per acre, where you wouldn't do that in a for sale situation. So what are those dynamics and the size of the unit and whether it's for rent or for sale, since you have some that are both?
Yeah, so we really play the spectrum on this, and I always tell people, we don't really chase a specific product type. We chase land that can have the best use of that land. So whether that land yields the best to have a multifamily plat over it of, kind of horizontal apartments, which have kind of gotten put into the build to rent community, which are 1 and 2 bedrooms, 750 and 1,000 square foot, basically a kind of deconstructed apartment unit, up to townhomes on 20 wide lots that can drive some pretty good density, to 0 lot line stuff, to 30 wide lots, to 50 wides, to 60 wide. So, if you look at our portfolio right now of the current deals that we have in escrow, we have every single product type that I just mentioned, and it's everything. And it's not because of maybe a specific business plan. It's more about, okay, how can we take this land and create not only a community that meets the needs from a demographic standpoint, but also from a yield standpoint, because at the end of the day, costs are high and you got to figure out how to create efficiencies inside of your community to really, lower your cost basis as many ways possible. And, density is kind of the easiest one to do that with.
Yeah, it'll be interesting to see how dense some of these subdivisions can get before they become unattractive.
Yep.
Talk to me a little bit about the environment the way it is right now, the economics. Are you getting nervous? Are your partners or investors or lenders getting nervous? You said you have deals in escrow. That can always be a little nerve-wracking situation. What are your current feelings about where we're headed?
Yeah, there's obviously definitely a shift happening right now. There's a window probably, my take is over the next 9 months, we're going to be kind of living in this super high construction cost environment, coupled with, high interest rates. And it's a tough time right now. That's just the reality of the marketplace. But, as we start to see the pullback from home builders, and a lot of my GC friends, that I speak with on kind of a weekly basis, are starting to say that the labor is calling them looking for work, which, you trace that back 4 or 5 years, that has not happened at all. So it means that there is starting to see a shift in the labor markets, which means materials follow along suit. So, as we kind of pull that back and everyone gets a little bit of a time period to catch up here and supply chain to catch up, you'll start to see that construction costs, start to trickle downwards, which, can kind of make up for, the absence of, rising interest rates and kind of cost of capital. But, at the end of the day, capital is learning that they need to be flexible and that they need to shift with the marketplace. And yesterday's standards aren't the same as tomorrow's. And that's just the world that we live in right now, which is something that is changing dramatically. And our headlines, can shift the marketplace pretty drastically without really looking at the true data, which is at the end of the day, we're in a deficit of units. And if we don't continue to build, if everyone continues to pull back, we just find ourselves in a deeper hole. And that is what you're going to see probably in 2-3 years play out from right now, is that, we're already ripped through too much inventory over the last 2 years, the home builders did. Trying to capitalize on what was happening, and they can't replace their lots fast enough. And now we're going to pull back because of what's happening. And all of a sudden you just keep feeling this, once again, deeper, darker hole of lot inventory shrinking. And if we aren't out there actually actively investing money to produce these houses, then, unfortunately, we're just going to be in the same position that we are today, which is, affordability being a major crisis in the U.S.
That will be interesting to see how it plays out, because you hit my point exactly. There's headwinds, there's tailwinds, and if the combination of those two things cause people to just say, well, I think we're going to be in a worse position as a country, right? Demand's going to continue to rise. People are born every day. People want to move every day. It's going to be a brutal environment. Steve, you got anything?
Yeah, I do. Hey, Mitch, thanks a lot for coming. I've been, as head of Rent TV, if you're familiar with us, I've been following True America for a while. So say hi to Bob and Noah for me. Thanks for lending you out to us. I appreciate it. And having tracked the company, I'm watching you guys go from California and buying properties across the country. It's always been my understanding the company's bought existing multifamily properties. So now, and never really built ground up apartment buildings. So now that's a major shift for a company like that. Yep. Culturally, within the business itself, what kind of change are you seeing, in the company itself to shift from buying existing properties to building ground up with the lead time and the construction costs that you're coming up, finding out about?
Yeah, I mean, it's definitely a different approach, right? Right. Different personnel with different expertise. And, I met Bob and Noah a while ago, and, at the end of the day, there's two pieces of this thing that have to exist, and it's what True America has today, and it's experience in the marketplace, right? Of underwriting, of resources, of, capital partners, and then operating, like these at the end of the day, when Build to Rent first started, it was a lot of grassroots groups starting this stuff of onesie, twosie people that,
just to cut in, what are how many units in your typical Build to Rent community?
So we have kind of like three different kind of approaches. So we have one deal that we have is 155 units of single family detached houses. Another one is 485, and that's a for rent component with a finished lot component that will sell off. And then we have another deal that's 961 units. That's more of a mini master plan with a couple of different build to rent components to it and a very large for sale component to it. So we look at this thing and we say, hey, how do you maximize the opportunity in terms of what parcels that you can look at, because that's where we are focusing on as a development company. And then from there, we can kind of ebb and flow with the marketplace based on what products we're using. But if you don't kind of cast your net wide enough, you're going to miss the opportunities that exist. And so we really wanted to say, let's try to approach it all. And at the end of the day, to develop 150 units takes the same effort to do 900 units. It just takes a little bit longer. And, when you kind of start thinking about that mentality, it also helps you kind of identify what key personnel that you'll need kind of nationwide. And we're working through that right now in terms of building a team out.
Right. Interesting.
Are you getting market studies when you do this? And are those, we had talked about the mix of how many bedrooms and stuff. Do you rely on those market studies in terms of how fast it's going to lease up and what unit mix and sort of?
Yeah, 100%. We dive through with the property management groups. We third party out our whole portfolio. So we have great relationships on the property management side and really leverage, what they have. Then we also jump in and do, full backup on all of our third party studies. And we do these very early on. We look at these and we say, to spend some money up front to identify how to best fit what this area of MSA needs. We definitely spend the money to do so, to make sure that as we're pre-planning all this stuff, that our product type speaks to what everyone's looking for, that our bedroom counts, our bath counts, our garages, backyards, all these different pieces and components are identified very early on, so that we're integrating them into the plan, which is kind of the beauty of jumping back in the process. You absorb risk, but you also absorb opportunity to kind of really make these things look and feel the way they should, rather than trying to, do that, square peg in a round hole type approach of something that wasn't planned to be built for rent. And now all of a sudden you're kind of flipping the switch and going the other way. We really want to approach this, holistically and say, we're deciding it from day one, and we're going to make sure that this thing fits perfectly of what everyone's looking for.
I got my feet wet back in the 90s when the condo conversions were the big boom, and everybody was taking old buildings or old apartment buildings, converting them to condos. And I was a CPA, and it occurred to me, all of the developer profit is in the last 2 or 3 units, right? That you could have a 75 unit building, 200 unit building. You didn't get those last few units sold. You weren't making any money as a developer. The 960 lots scares the crap out of me from that perspective. So I'm glad to hear that you're doing a lot of homework and that you feel like those last 300, 200, 100 pieces that have to go are that you can be fairly certain going in. That those are
Hey, Todd, I got one last question for him. I know there's lenders on here. So I got to ask you, what's the difference in the capital stack? How are you financing these projects versus a typical, apartment purchase? In terms of equity, LTV?
Yeah, I mean, the LTVs, LTCs have, definitely dropped, over the last year. Obviously, rates are what they are right now and ever changing.
Are you just doing one lender, or are you bringing in you stacking it up? How are you doing it?
Yeah, so a lot of the lenders now are looking for efficiencies. They're looking for great sponsors, and they're looking for how can I scale with my great sponsors, and that way it limits how much work I got to kind of put into this thing, because doing 10 deals, one off is a pretty difficult process, and so that's kind of where things are shifting to. It's really saying, hey, I'm going to get down to my good core guys, and I'm going to kind of streamline everything with them. I'm not going to hold back capital. I'm going to give you more, but it's going to be more streamlined to help you grow. And that's kind of what we're seeing right now is that. And if you have a good sponsor and you have good equity partners and you have good operations and you have the right team in place, like
What's your typical lender? Bank, Lifeco? What's your?
Yeah, I mean, we're chasing banks right now.
Uh-huh.
What's that stuff? And you know, the lenders have started adopting the build for rent strategy, you know, a few years back, and so now there's a lot of products that speak to this, where it's, you know, acquisition and development loans that roll into construction loans that roll into kind of mini perm loans and allow you to kind of spin these things out into more of a long-term perm financing position. So there's some great products out there that speak to it. It's just at the end of the day, when costs are high and LTCs drop, you need a lot of cash. And so that's where the space is going to start to say, you know, big time sponsors are going to be the ones that really take a big step forward here, because it just requires, you know, a lot of money, and that's just kind of the reality of where we are in today's market.
Right.
That's a great
No, that's of interest
transition.
to a lot of people on here, so I had to ask that
Yep.
question.
Yeah, that's a great transition. We're moving over to Evan Linkner, Ackman Ziff. Mitch, thank you so much for your
Mitch,
time.
thank you.
Your generosity.
Absolutely, guys.
Great company, and good luck with those projects you got in the pipeline. Evan, there we go. How are you?
Good. Thanks for having me on.
Thanks for joining us. Ackman Ziff. I was told by Simon Ziff that you guys are jumping into this space and have done some pretty good sized deals and have some stuff in the works. So looking forward to hearing that. You want to tell us real quick about your company and then what?
Absolutely. So Ackman Ziff is a 96-year-old institutional capital advisory firm. We place debt, equity, structured finance, generally for institutional clients. I lead the special situations group and head the BTR practice. And we've been very active in the sector, not jumping into it really since 2012. We've been involved in both SFR and BFR. Really, 2012 started doing SFR, and then in the mid 20-teens got very active in the build for rent sector with some of the very large and early entrants. And it's really grown since then. Really, since the acceleration of the sector, we've closed over $4.5 billion of debt and equity capital placements that we've structured. And we currently are under exclusive mandate of over $5 billion. Our average transaction size are generally $100 million up. Average transaction sizes are right now in the $300 to $400 million range of capital placement. And we bank some of the largest borrowers and sponsors in the United States. Most of the names you know.
Yeah, those are no small deals. Congratulations on the pipeline. Good luck. I think things will go well. I think this marketplace is going to continue to boom, but we'll see. So tell us what, we're in a weird situation. Okay. It's July. Interest rates are up. Inflation's up. Doesn't seem to be under control. Everybody's nervous. What's keeping you up at night right now?
Yeah. So really what's keeping me up at night is just where are the capital markets going? The capital markets currently are disrupted. It started really in the traditional securitized capital markets in the early spring, and really in June when the inflation number came out, then that caused a significant capital markets disruption, and obviously the latest inflation number to come out was not positive, but we did see, like, after the June number came out and the guarantee and the Fed 75 basis point hike, that was a big drop in liquidity. And with this last one, even though the inflation number was higher than expectation, it's really has just been a little bit more stable within the disruption rather than another significant drop in liquidity. And so the way that we look at it is, as long as there's liquidity in the capital markets, we can create overall structures to help our clients. And as Mitch was saying, that, especially in this sector, we're generally banking the larger institutional partners, and so there is a bit of a flight to quality right now.
That makes me nervous about the middle group, right? There's a lot of small single family operators. They'll find a way to survive. They're scrappy. Local banks will figure it out. But the middle group, we need them to be producing. And if it's only the bigs and the really smalls, it'll be interesting to see how it all plays out. Today how Steve asked this question, but the LTV requirements and the cash requirements, and how is some of the underwriting evolving, and is today the time to really start to lock in these things, or do you feel like things are going to get better or they're going to get worse?
So So, I don't know if they're gonna get better or worse, but it's really over the long term is really trying to think about it. What we're seeing with our clients is now is a good time to grab liquidity on it. LTVs and LTCs are going down, and really the largest driver of that is base interest rates. Because what we always were thinking about LTV as our main constraint, really the main constraint in both our construction as well as non-construction deals are really the rates and DSCRs. And it's really something we haven't thought about for many years because we've been such in a low interest rate environment. And so on the construction side, we're looking at the takeout loan, and the construction lenders want to be able to be taken out. And so DSCR is their constraint on that side. And then on the floating rate deals as well as the fixed rate deals, it's a DSCR constraint on it. So we're seeing leverage come in significantly, and spreads go up along with base rates.
We have a very mixed audience, Evan, so I hope you don't mind if I translate a little bit. DSCR,
Okay, yeah.
debt service coverage ratio, correct?
Yeah. Sorry, Todd.
And then that's how much extra cash is left after paying the mortgage. So how much, it's a kind of a cushion estimate, right?
Right. Yeah. It's basically how much cash after you pay your interest as well as all of your operating expenses within an asset base.
So in that pro forma, are the lenders able to underwrite rent growth on that scenario? Or are they saying today's rents are today's rents? If you're in Phoenix right now, rents are going up 25% a year. It's a whole different metric, right? When you're looking at your takeout, or are those numbers just not sustainable or not believable?
So we look at rents that are untrended, and we look at rents that are trended. So with rent growth on it, and there's different metrics that are used for different lenders. And some lenders will give you credit for trending rents, and some lenders will only look at the untrended number on it. What we like to do is we like to get a third party market study on it and try and use those third party verifications on the rents to give lenders some better guidance of how they should be underwriting rents. But generally now, most lenders are thinking, okay, what are today's rents, and can I be taken out of this loan at today's rents?
Steve, do you got anything? We're going to talk geography.
Yeah, well, my first question was in the scheme of, you guys are so big, in the scheme of things, is this still a small portion of the business, the build to rent space? And do you see it, growing within Ackman Ziff, to become more prominent?
I mean, it's a very significant portion of the business right now. And we early on saw that this was a good sector for all the things that people were saying before, where it's really a demographic play. Early on, it was, okay, how do we get assets cheap on REO? Then really in between 2013 and 2018, we were only doing structured finance in the sector. 2018, the information started coming out that millennial consumers were forming households, although later, and then when they were forming households, they had a propensity to rent. And even 2 or 3 percentage points on propensity to rent is millions of houses in the United States. And at the 2018 is also when there was a lot of information from the securitization market of how houses were being operated. And so really, for most people, saw the acceleration of the sector in 2020, which was a very significant acceleration. But really in our business, it was in 2018 where we saw a very significant inflow of capital into the sector because of those reasons.
Interesting. And getting into the geography, are there geographic areas, that you see that are obviously more friendly to this type of development, where the economics work better, where you see more longer term growth and better investment opportunities?
So we're in the SFR sector, where it's a very national business. I'd say the smile states are where there is the most growth, and also there's more land available. But we're doing single family rentals in California. We're doing single family rentals even in the Midwest too for build for rent as well. It's different metrics and margins on those. But I would say the vast majority of the concentration of development is in the Southeast, Florida, and Arizona, Texas, Colorado.
Interesting.
Yeah, it'll be interesting to see how that plays out. We got our next guest, David Howard, with the National Multi-Housing Council, and he's going to have some information on demographics as well. Evan, thank you so much for your time and insight, and good luck with those closings you got coming up. And it was a pleasure to talk to you and hear about all the great things going on in Acton.
Yeah, thank you, Evan.
Yeah, thanks, guys. Talk soon.
So take care.
All right, David Howard, are you there?
Yeah, Todd, I'm here. Can you hear me okay?
Excellent, I can.
Perfect.
Why don't you tell us a little bit about yourself and the entity and what you guys do for the industry, and I'll try to dig up your slides here.
Yeah, happy to, and I appreciate the opportunity to speak with you this morning, Todd, and field any questions, provide any information that I can for those participating. I'm David Howard. I'm the executive director of the National Rental Home Council. We're the Washington, D.C. based trade association that represents the single-family rental home industry. Our members include the very large players in the space, publicly traded companies, private institutions, all the way down to the individual owners and mom and pops who account for so much of this market. Again, we're based here in Washington, D.C. We do a lot of legislative and regulatory work on behalf of the industry. We also do a lot of the more traditional sorts of trade association activities. We have a pretty substantial annual conference. It's held every spring. It's going to be in April of 2023 in Nashville. So very much looking forward to that. We do a lot of work around best practice, particularly as it relates to operating issues of relevance to single-family rental homeowners. I've been with NRHC now since September of 2019. Prior to my time with NRHC, I've worked with or for the National Association of Home Builders, the Urban Land Institute, the National Association of Real Estate Investment Trusts. So I've kind of been around real estate focused trade associations, certainly for the better part of my career.
We appreciate you coming on and sharing your knowledge with us. I thought that chart that I put up was probably one of the more interesting things of what I was able to get from your website, which is very informative, by the way. So if you haven't checked that out and you're watching right now, it's a great organization to join and browse through. There's a lot of good information there. But I think we hear in the headlines all the time, it's the big players that are making this market happen. And it's really a combination of both. And the big players maybe don't own as much as you think. What are your thoughts on that?
So it's really interesting, and it's certainly an issue that has been receiving some attention. I think it's really a symptom of the sector itself is becoming more and more recognized as a legitimate asset class unto itself. And certainly the large owners within the space are attracting, I think, the most attention. Some of that is good, some of that is not so positive. I will tell you in terms of context, and we have these conversations a lot, whether we're talking with politicians, elected officials here in DC or in states across the country. It's always helpful to kind of set the table so people really understand the numbers. And what I like to tell people is, first of all, single family rental homes account for about half of the rental housing in the United States. So there are about 23 million single family rental homes in this country, which includes traditional detached single family homes. That accounts for about 16 million of those homes, but also townhomes, duplexes, triplexes, that sort of thing. So it's a big market. I think people, when they think about rental housing, tend to gravitate toward apartment buildings in Washington, D.C., New York, Chicago, what have you. But again, the reality is half of all rental housing in this country is considered single family rental housing. Of that 23 million universe of single family rental homes, the large institutions in the space account for about 1.5% of that market. So, it's anywhere from 300,000 to 350,000 homes, depending on how you define large owners. But, when you see the Redfin reports, when you see other articles and publications that speak to investors, investor activity, institutions buying every home in every community across the country, we like to try to get out in front of that to the extent that we can. And again, drill down to the numbers. The large institutions, again, the public companies, the private companies, own about 1.5% of the single family rental homes in this country, which equates to, and this is sort of the punchline, which equates to about 0.2% of the residential real estate in the United States. So those 300,000 to 350,000 homes that the large institutions own, again, equate to about 0.2% of the homes in this country. So that, I think it means a couple of things. First of all, large institutions are not buying every home in every community across this country. I thought your previous panelist, Evan, made some good points. You're seeing the lion's share of activity, certainly with the large institutions, in markets like Charlotte, Atlanta, Nashville, some of the Florida markets, the Texas markets, certainly Phoenix, Las Vegas, and then to some extent in Southern California. But there's a large swath of the country where large institutions own 0 properties. Members of NRHC, for example, don't own any properties in places like New York State, Massachusetts, most of the New England states, most of the upper Northwest, most of the Pacific Northwest. So again, large swaths of the country where large institutions don't own any homes. They tend to concentrate on those markets where you see positive demographic growth, positive population growth, and strong, dependable employment growth. And so these are markets, again, like the Charlottes and the Nashvilles, where we've seen tremendous population growth over the past few years. These are markets, the Dallases, the Fort Worths, the Austins. These are markets where companies are gravitating toward. The companies who are there are expanding and bringing in more employees. And when you think about it, when people move to a new market, they tend to rent, not always, but in a lot of cases, while they figure out what their longer term housing needs are, where they want to have their kids in school, how they want to figure out their commutes to their offices, their places of employment. And so, again, when you look at a market like Atlanta, here's a statistic for you that I like to throw out. Last year, there were 117 people every day of the year who moved to the Atlanta metropolitan area, 117 people a day. Charlotte is a little bit less, but even Charlotte, 100 people a day moved to the Charlotte metropolitan area last year. And so these are markets where the demand for rental housing and single family rental housing in particular have been extremely strong. And so that's why you're seeing a lot of interest in those markets by the larger owners. That includes both sort of the traditional model, the model that has existed in the single family space where companies will purchase homes that are either already rental homes or owner occupied homes that will become rental homes. That's kind of the traditional model. But in those markets, you're also seeing an awful lot of build for rent activity. And you mentioned the information that we've got on our website. We've got some data pieces about build for rent. One of the more interesting and one of the more recent pieces that we've put up has to do with the fact that companies, the larger companies in the market, are increasingly transitioning to build for rent activities as a way to grow their portfolio, as opposed to purchasing homes and converting those homes or continuing to rent those homes. And Todd,
Yeah.
just put up the slide that I'm referring to.
It's a little hard to see, but if you look at the build for rent, I'm kind of hovering over it right here. It's gone from 3% to 26% over a 2-year period, it looks like. And the portfolio purchase has gone the other direction. That is interesting. David, there's another slide though here. This is the one that almost knocks me out of my chair, okay?
Yeah.
Because I should really just drop what I'm doing right now and go start building for rent homes in the Smile States. I'm from Minnesota. There's not much going on here. It's going to get cold soon. Time to jump in the truck and bring a backhoe with me because this is insane. The spike here, this blue spike, tell me about that and what's driving it.
So let me put in a plug for John Burns, real estate consultant. We do a lot of work with the folks at John Burns, and this is one of their data sets. And basically what it shows is it's more expensive to own a home today than it has been over the past 20 years. So when I say own a home, they looked at the average monthly mortgage payment versus the average monthly rent on a single family home. So not including apartments or multifamily.
They throw in taxes?
I'm sorry?
They throw in taxes?
They did. They threw it.
Right.
I think, and you'll have to read the fine print and even contact the folks at Burns for more information. But I think it's based on a standard 20% down payment. They use some figure for the median home price, but it includes insurance, taxes, and a lot of those costs. And again, what it shows, and again, if somebody watching this wants to quibble about a number here or a number there, I get it. The bigger point here is the difference between paying a monthly rent on a single family home and paying a monthly mortgage on a single family home is at its greatest differential than it has been in the past 20 years. So, and by the way, this data goes through, I think, 2 or 3 months ago, maybe it was the last quarter. The folks at John Burns are updating this chart, and it shows that $839 differential is now even larger.
Yeah, I see April 22. I think, yeah, you're right, David. People could argue about the semantics and how you make the calculation, but however you calculate it, it's spiking. And that gap is growing wider. So you talk about the big people, and I mentioned this a little bit ago, you got the bigs, the smalls, the middles. We're going to need all of them to meet the demand that's out there. And the math is going to work a little bit easier every time this gap grows, right? Every time you think about a project and the rents go up or the cost goes up for the other alternative and people need to rent, there's opportunity there to grow that market space. And there's need and demand, right?
That's very true. And, Todd, there's been some pushback on the industry, again, particularly with the larger owners, that we're creating this nation of renters, that rentership is becoming the new norm. But, again, the reality is something very different. There's actually, this should be of interest to you, Todd. There's actually less rental housing in the United States today than there was 5 years ago as a share of the total housing market. I'll say that again, less rental housing today than there was 5 years ago as a percentage of the overall housing market. The amount of owner-occupied housing in the United States has increased about 10% over the past 5 years. The amount of rental housing has only increased 2%. So when you think about the supply constraints that we all know about in terms of the new home market, if there are supply constraints in the new home market, there are going to be supply constraints in the rental housing market. And that's what we're seeing. And so you couple that with this surge in demand that's out there. And to your point, Todd, you can really make a strong case that there are good and legitimate reasons why we need more rental housing in this country, both multifamily and single family.
Going to be fun to watch it play out. Steve, we've got 2 minutes left with David. Any questions?
I was just going to ask just a quick, easy question. Dave, when did you guys notice the actual build to rent segment? When did you guys break it out as its own category?
So it's probably been over the past few years, 2 to 3 years. There's always been build for rent, but it's mostly been kind of one-off urban infill kind of stuff. It's really only been over the past 2 to 3 years that you're starting to see an investment in at the community level, planned communities, pieces of master planned communities. You're seeing the big production builders partner more and more with rental housing operators.
Are you seeing a shift from projects that would have been typical sale projects now that are being shifted over to the build to rent?
Yeah, we are seeing a lot of that. So we're seeing with the production builders in particular, we're seeing if they're planning a 250 unit community, they might have targeted 25 of those to be for rent. Now that 25 is 50 or 75. So we're seeing larger shares of communities by the production builders being allocated to single family rental.
Yeah, they're probably seeing that spread in the cost that you had alluded to before, and saying that.
Well, and I think what they're realizing is, people want options, right?
Right.
Some people want to buy a home. Some people want to rent an apartment. Some people want to rent a single family home. And so, that's really what's behind all of this. I talked about the demand before. That's a really important piece of this, but it's also about giving people choices and options.
Right. And I think it's on the flip side too with the developer, because as Mitch was saying too, they'll get in and take down the 900, and some of those they need some flexibility built in with what they're going to do with some of that. So
yeah, that's a good point, Steve. That's a good point.
On the backside too, so on the supply side. So there you go.
Well, David, thank you very much. It was an honor and pleasure. I want to make a last plug for your association. Anybody that's watching right now and you're just getting into build to rent or you're expanding it, I think having someone that's the voice of the industry is extraordinarily important, and I want to support that. Make sure that everybody knows the information is there. There are people in the chat room, David, asking for slides, I'm going to
Okay.
direct them again to your website where there's a lot of information, more than I showed on the screen. And I also will make them available in this in the platform you're watching on right now. There's a place for slides and things. I'll get them up there and send out an email. But appreciate
Perfect.
it.
And if anybody does have questions, I think my contact information is on the site for the conference today. So feel free to check that out and shoot me an email if you need more info.
Thanks, David.
Thanks.
Great
All right.
job.
Thanks, guys.
Thanks, Bruce, for us too.
All right.
All
Appreciate
right,
it.
Mark Birch, Templeview Capital. We'll talk a little bit more about lenders, maybe a little different flavor on it.
Sure.
Let's see. It looks like you got your camera on. You just want to jump in, tell us a little bit about Templeview and yourself and what you're up to?
Absolutely. Absolutely. Thanks for having me on. This is great stuff. Learning a lot, great perspectives from all around this space. Templeview is one of those lenders that I think someone was talking about earlier that's kind of jumped in here. And really, we're a leader in a fix and flip environment. So we originated ourselves, and our only product that we have was a fix and flip product. Okay. And we did a very unique play on fix and flip where we advanced draws out to certain investors that had some experience, and we've proceeded forward to then start lending to other investment types such as investment properties, multifamily. Then we got into the ground up in the build to rent space, and the numbers that are being shared are absolutely spot on. And we're very excited about the future. We're a company that is structured a little bit different than some of the other lenders on the street. We have our own money and our own takeout. So we are going to be here for the long haul. You do see a lot of companies being acquired, or they've stopped lending, or these things happening in our space. We are not one of them. We have our own direct takeouts, and we are here for the long haul. Our rates have increased. Lending is going to kind of take a play in different things that you can offer. But guidelines per se are still going to be around to really enhance that investor we're going for. So the person looking to acquire something, add some value into it, and sell it for profit, or add some value into it and refinance it into a rental property. We are there to be a lender for them. We also have got into the short-term rental space. It is one of these things that we kind of launched last year when we saw that the average DSCR of a short-term rental is close to 400 percent, or 4. But most of the times lenders are around 1 to 1.5 on a DSCR ratio, and most of the things we're seeing in the short-term rental space are north of 3. Which we want to be all over that. So we have developed a product that helps do that. And we actually seen some builders and different people doing build to rent are actually creating build to short-term rent. And this is some of the things that we're seeing, kind of a new product space. And we're pretty excited about that as well. And in general, from my background is that, typical business development account rep who's seen everything. I mean, I personally am using our own products. I have 20 properties on the short-term rental space. I've got some regular rental properties. I've got some other assets and multifamily that I have invested in. And of course I do some fix and flip. So I actively invest, which helps me really kind of build relationships because I actually know how to set expectations. I think one of the things in this space is being able to say no from a lender's perspective to build relationships. And that's one of the things that we're building with different things. So if you're interested in working with Templeview, we do have different types of relationships. We do have correspondent lending. We do have table funding. We do have different ways to help a company go from, A to B as far as if they're looking for capital, because we can white label all of our products. We have a nice business to business operation that really takes risk out of different lenders and correspondent lenders that, just you'll allow us, Templeview, to do all of you due diligence, underwriting, and provide you guys a clear to buy or, table fund ourselves. So, in general, I just wanted to kind of give you an overview of Templeview. We are only lending to, we're only in the space for investment purposes only lend to LLCs. We are a nationwide lender, soon to be in all 50 states. But yeah, we're definitely in for the long haul and excited about, the opportunities that we're going to see in the future, just with, the lack of, lenders in the space, the constricting and people looking to be able to sell off product.
Well, it was interesting to hear Evan say that he's in the big space, right? Big dollars, zeros don't seem to bother him. It's just it's not even an integer, right? Zero's not an integer, so they don't matter. But you're probably running a bigger spectrum of borrowers. Am I correct on that?
Yeah.
So how is that smaller middle space affected by living with the inflation and interest rate sort of environment that we live in?
Well, I think there's a couple ways to answer that. First of all, the people that were trying to get into this, as let's call them the newbies, right? They're like anything else. They're going to kind of fall off. Their money that they might have had that they were going to put into an investment property, they're going to hold it elsewhere. I mean, because at the end of the day, one of the things that when you're talking about the money that people, the skin in the game, this is what is going to change in the future, right? So you're going to need most institutional investors, most of the people that have done this 5, 6, 7, and then of course our platinum borrowers. There's plenty of money. So really it comes down to finding the deals. And then what you've said and what you have alluded to before was just the kind of the opportunity that I see is that you're going to have this kind of transition to people getting their hands or trying to get more rental properties. Vacancies are all-time lows across the board. It's like the slide said a couple of minutes ago. It's a lot. It costs a lot more to own than to rent. And so I see a lot of people going into that right now from the perspective of just what you see on the MLS as far as rentals go. If you look and you try to search for rentals in a geographic area, you're going to not see a whole lot of them listed because they're basically, the vacancies are so low that people are waiting for them to come on and they stay on for a few days and they're rented. There's also another play there that's happening in this rental space, and there's another product line that people are actually doing corporate leases. And so when you have the corporate leases going out there and the short-term rental kind of buzz, and you hear all these people being able to kind of arbitrage the different rents from short-term rental to regular leases, the inventory almost goes away, right? So I feel like there's going to be an opportunity with the fact that we're finally going to be getting some foreclosures moving forward. You're going to have some inventory come up. You're going to have some people take that inventory. The more seasoned people that have cash, they're sitting on cash. Most of the people I've talked to in this space, most of my big lenders and my big investors, they're literally sitting and just waiting, right? They're putting in offers. They're being very strategic because, they're playing off of the scarcity that's out there right now. What's going to happen in the real estate market? Well, it's pretty simple. We still have the problem of inventory, and we still have a lot less people being able to afford to buy these different types of houses. And I can tell you right now that most people that were buying, and I knew some of these people personally, that were buying a house that needed work because they couldn't afford the turnkey property, but they were buying it owner occupied. So what's going to happen now is those people aren't buying those anymore, right? You're going to have other people in that space, investors in that space, looking at that more as a flip opportunity and being able to get it under the market. So you're going to start seeing those properties be, one of the things, be lower, but one of the things that I think people didn't realize in COVID is there was no floor, right? REOs are floors. So when you have REO inventory and you have inventory coming onto the street from banks that really didn't have that inventory, you never had a floor to go off of for just a regular mom and pop listing a house as is, right? They were getting retail rates and not really seeing a big reduction of what they were going to be able to get for their house because there was nothing else out there. And so these are some of the things that are going to be changing. And again, for us, I think more of the new investors are going to make their way out of the market. I think most of the seasoned investors are going to be here for the long haul, and they're going to make some money because no matter where this exit goes or where the real estate market goes, the truth is the rental rates are still going to go up. So whether you're going to buy it and turn it into a rental, you're still going to see the ability, because the only way we're financing it, if it does make sense for the takeout, right, is the fact that you're going to see it debt service and that debt service to cover. So you're going to see better renters because you're also going to see the renter themselves be, someone with better credit that were basically in the market to buy a house. So their credit's going to be substantially better. They're going to be a better renter, and they're doing it to basically platform themselves to when they buy, right? So they want to make sure their rental history is great. They want to be a great renter for the next level. So you're going to see, as a person that has a lot of renters right now, trust me, I'm getting paid on time every single month right now. I'm getting people wanting to pay their rent because they know it's going to go up. And they also know that they're not going to have an option, elsewhere, right? If they leave my rental and they go somewhere else, it's going to be more, and they might not be able to get in there. So I actually am pretty excited about the next couple of years here, just because, I'm vested in it, and I think it's going to be, home run.
That's a different take. So you made a really good point. That's interesting. That people are going to make money today. The people that are in it for the long haul, the deeper pockets, the more experienced people. I think that's really interesting. A good friend of mine who's a little older than I am said, Todd, you'll never make money the way I made money, because he made money in the S&L crisis by buying properties cheaper. Is this a buy opportunity that's going to unfold? And how much legs maybe does it have? And what are the conversations you're having with other people about rates? I'm hearing from a lot of people they're freaked out about continued rate hikes.
Well, I give an example of rate, okay, which is ridiculous. But I had a 4-unit property that I was going to look to refinance. However, I'm waiting for the deed to be recorded. When I was starting the process, it was 3.5% on a 30-year fixed. Okay, right now the same exact 4-unit building that I'm looking to get refinanced, the interest rate's 8.5%. So it went up, 5% between, in 1 year. Okay. And that, now remember, so there's something to be said there. It's a 4-unit building. It still cash flows at 8.5%. It's still like a 1.8 DSCR. But to your point, rates have gone up. So it is going to actually turn. So it's going to force it's not only going to, can you still make money as a rental? Yeah, but it's going to force rents to go much higher, right? Because someone's not going to buy that house as a renter if they're not going to make money. And so if it's a 4-unit building and my rate is not 3 or 4 or 5%, and now it's going up to 8.5%, it's actually going to ultimately fall on the renter. So the rents are going to increase for the main factor, the interest rates have gone up. The other part of your question is, yeah, I think there is going to be a buy opportunity because of just you still have that lack of inventory, and then you still have the buyer so the buyer they're still wanting to buy, but they have changed. Some of the people I even talked to have changed into renters that weren't necessarily on the buyer side. So they do want that nicer property. They do want the nicer rental, the one that has been renovated, not necessarily the one that's, a 15-year rental that is, just run down a little bit. So you're going to see the exit strategy on someone that's looking to make money, have a couple of different opportunities depending on where you're investing. So you always want to be looking at where you're investing, because that is going to tell you, okay, well, I can look at this as a flip, or, right now I could get X amount of dollars in rent. And, that number is going to increase and is going to change. So I do think with, from what I even seen with our own inventory and different banks that I've talked to and different people in the street, is that you're going to have more, lenders, being, instead of rehabbing and putting money into a house, they're going to be changing their perspective to sell it as is. So you're going to have more inventory. And one of the other points, Todd, is, I think this is the biggest point, is you still the institutional buyers are still buying. If it's a 3-bedroom, 2-bath in Houston, you are not going to be able to beat out anyone other than Blackstone, right? They're going to buy this thing. They're going to buy that house because they want the renter. And one of the other things is, when they buy, it's never coming back on the market, right? So institutional buyers that are buying rental properties because they see what's going to be happening with the fact that they're going to be able to get a return, increased rent, is that, these properties that we already have a low inventory are still leaving the market and they're never coming back. So I think all of that's going to still lead to a housing not a crisis, but a correction. I think I think you're still going to have a demand. You're still going to have, people buying. And I think, like I said, I'm not like I was in this 2005. I don't know if I was a part of it. I worked for a company called First Franklin, which is a subprime mortgage company. But, I was there when we had the other crash. And I think the huge difference between then and there is the irresponsible lending on no skin in the game, right? What are we all changing right now is an equity position, skin in the game, because if you do see a correction in a decreased environment, you still have put money into that. There is still margin there in the bank. One of the things that people don't realize is that this number that most lenders like Templeview and everybody else on the street, we have an ARV cap, right? We're not going to lend past 75 cents on ARV, right? And that is not just an ancillary number. That is actually the number of a defaulted note and what it's worth in the environment of default. And again, that number is fluctuating right now. And that's why you're going to see our ARV numbers go from like 75 to 70, because that's what the cost of the street's going to be. So if I sell a defaulted note, someone typically is going to be willing to pay about 70 to 75 cents on the BPO value, so the appraised value. It's not about what the person owes ever. It's always about what the house is worth. So, all of that stuff is really kind of, because we're directly tied to our takeouts on Wall Street. So we're tuned in pretty closely what people are willing to pay for it. So, rates, they go up, they go down, and it's really just a factor of, where the price is of the house. So.
Well, Mark, great take. Appreciate you coming on the show and Templeview, and look forward to hearing more from you in the future, and good luck with your flips and the other plays you got going on. It sounds very exciting.
Yeah,
We got to bring in Cliff Payne here. Sorry to cut you off, Steve, because you didn't get a chance to get in there, but let's move over to Cliff. Thank you, Mark. Cliff's with a company called Oxenfree, which is actually part of Core Spaces. Cliff, do you just want to give us the 30-second rundown on why you joined Core Spaces and what you got going on?
Yeah, sure. So Core Spaces is the parent company, has been in the residential accommodation, specifically student housing business for the last 10 plus years. 2020, they launched the single family build to rent platform. I came on about a year ago to help grow out that team and push our efforts into the space.
So the threshold question is why? Core Space is a very successful student housing company, has stuff all across the country. And I'm not questioning you as in I know better. More just what were the drivers? What were the things that attracted them to bring you on board? And then where do you see that evolving? Because things are obviously in a little bit of flux.
Yeah, so I think, people think of student housing today, which, Core Spaces is very active in, is very kind of infill, high rise, highly amenitized locations. But actually the origins of the student business were cottage-like, detached product miles off campus, which actually looks and feels very similar to the build-to-rent industry today. So, the origin of the student space, very familiar to what folks and we're doing in the build to rent space. I think the other reason is, the students and residents at our colleges are now the millennial generation that are looking for more space and moving out to these suburban communities. So that's a demographic that we know well here at Core Spaces. So those two reasons were really big reasons for the push. And since, in the last 2 years, we've really kind of built out the team and supplemented the team with folks that have, for sale or single family residential experience to pair that, with Core Spaces expertise in the student business.
So you're listening to your current tenant base in the student housing. And so I brought up a statistic earlier and I couldn't find it again. So I think I must have been in my imagination, but I think it was Rent Cafe or somebody, but they had reported that X percentage, and I thought it was like 60 or 70%. Of renters would consider or wanted to consider a single family home rental for their next rental. Would you say that that's the demographic you're following? And is it accurate? Is there really that much demand out there?
Yeah, I think we bucket the demand in a couple different categories. One is kind of what we call the move ups. So these are, more of the millennial age group that is looking for, more space. Maybe they have pets or young kids, looking to move out of some of the urban, lifestyle into more suburban, private direct access to their units, some green space for pets or otherwise. The other demand demographic are the switch ups that we call, I'd say a little bit of older demographic that is looking to maybe release equity from their home, want more flexibility in terms of where they're living. And a community like ours or a build to rent community would be a great place for them. And I think the third bucket would be, transitionals. Maybe a life event occurred and they want flexibility for a period of time. They're waiting for a home to be built. Can also drive demand to our communities. And so I think there's different demand kind of demographics, which I think we love, given we're not reliant just on one cohort, but there's different demographics and ages that really create a vibrant community and demand for our product.
I love you use the term cohort. You totally work for a student housing developer when that's your term of choice. I like how you categorize those groups together. And it's very interesting. You brought up a point about amenitization, and I assume that means quality and breadth of amenities. What does the focus look like? And can you be specific? Like what would I expect to get at one of the communities that you're planning?
Yeah, I think we're, taking our kind of design amenitization DNA from the student space, and, really disrupting that space in terms of the product offering that we're offering and continue to offer in that space within build to rent. And so we focus on a little bit larger community sizes to support that level of amenitization. So, our community sizes are averaging kind of 300 units plus, which I'd say is a little bit on the larger end of the average. And we really want what we call our field house to be a central place of gathering for the community. And so there's different dedicated areas within that field house that may be, 7,500, 10,000 square feet community center. That's really the heart of the community that allows folks to come, swim in the pool, exercise. We're not talking about gym facilities with, one treadmill and one bicycle. I mean, this would be comparable to a regular fitness facility that you would go to off-site, but now it's at the convenience of the community. Children play spaces, dog and pet amenities, is all part of this field house. I think is really where we're trying to differentiate the resident experience.
So to accomplish that, are you urban, suburban, third tier suburban, rural? What markets does that fit in? And then also geographically.
Yeah, we're trying to find the sweet spot between, some of the for sale builders that I think are really pushing into, some frontier or larger outer ring locations where they need to get, many, many lots to kind of fit their business model. Contrast that to maybe some of the more what we characterize as horizontal multifamily groups that are doing a bit denser product, 15 plus units per acre, heavy maybe townhome or 1 or 2 bedroom product. We're trying to find those locations kind of in between where, really great access to major employment nodes. But obviously, we need enough land and at a price that makes sense where we can do these 300 unit communities. So trying to find that sweet spot maybe between those two players. And I think we found ourselves to be very effective in that. And in terms of just, I think your second part of that, Todd, is kind of where we are. I probably no different than a lot of the other build to rent players out there in terms of the higher growth MSAs. We've got 10 target MSAs, ranging from some of the markets in Texas to Colorado to the Carolinas, active in Nashville and Florida as well. And then we've got a couple projects going on in our backyard here in Chicago as well.
It'll be interesting in Chicago because I'm from Minneapolis, and I had a little PTSD moment to wintertime when you said clubhouse, centralized clubhouse. Do you have snowmobile drive-ups? What? It
Right.
creates a whole different dynamic.
I think part of the pitch in those, colder weather climates is the maintenance-free living, right? So you're not having to wake up and get your, snowblower out and, shoveling snow. I mean, that's part of the maintenance-free lifestyle that we're offering. So it's, of course, something we've got to underwrite in from an OpEx perspective in those colder weather climates. But I think it's part of the pitch to the residents is one less thing you have to worry about when you're living in one of these communities.
We wear it like a badge of honor. You do shoveling that driveway.
Hey, Cliff, I'm curious, how many units, core space is pretty big from, I know you're developing all over. How many units do you guys have totally in your portfolio, and what percentage is the build to rent segment, and you see that, I assume you see that growing.
Yeah, so I think the count, Steve, overall in terms of the broader core spaces platform is like 35 to 40,000 beds and units overall in the platform overall. As the build to rent is a bit of a newer division or focus within the broader core spaces, it's a smaller percentage. But today in build to rent, I'd say we control about 6,500 units across those kind of 10 target MSAs that I noted that are kind of in various stages of development.
Sure. And you see that growing as a percentage within the company?
Yeah, definitely. I mean, I think obviously I'm biased, but the market opportunity within single family is just massive. Student housing, I think, has become very institutionalized and has grown over time. And I think will continue to be active in that space. But, as I think the single family rental is just massive. Residential is the largest asset class globally. It's bigger than equities, fixed income, trillions of dollars, and the institutional penetration within single family rental, is just a very, very small fraction. And so I think there's a huge, massive growth opportunity. I see kind of build to rent within core spaces, continuing to gain market share, as you may say.
How early do you get in on the build to rent deals, and how early do you get in, and how do you find them?
Yeah, I mean, we're willing to play up and down kind of the risk spectrum. So everything from tying up, farmland that may be unentitled or not zoned for use, and working through, the zoning and entitlements on that land in locations that we're really excited about, to looking at income producing some acquisitions in the space as well. And there's kind of different risk profiles along the way of you can acquire entitled lots, develop lots. And so I think we'll be active along that space. I think most of what we'll do is, development, we're a development company by origin. So I think that's our DNA. And I think we'll do more development than we would acquisitions. But we're looking for ways to get scale.
Land brokers bring you deals? You deal with brokers?
Yeah, certainly the brokerage community is active. We've got local boots on the ground in the different markets that we're active in. And a lot of those folks have come from the for sale community. So they've been kind of sourcing dirt and lots and units for the for sale world for some time. So, a lot of established relationships, in the local markets that can bring us, interesting deal flow.
Right. And the lead time has got to be enormous in terms, depending on, the infrastructure you got to build and the zoning and everything. It's got to be kind of tough to predict. Probably.
Yeah, development takes a while. It's nothing short term in the development business.
Right.
And hence my comment, there's different ways, there's groups that will just do entitlement work and look for buyers, where they'll actually develop the infrastructure and lots and look for buyers as well. And, there's people that are delivering units and looking for these forward takeout structures. So, some of that we've looked at as a way to kind of accelerate some of the bread and butter kind of development business that does take a long time, as you were alluding to.
Sure.
We got a minute or two left. Do you mind if I jump into the entitlement process a little bit? It's something we haven't touched on.
Yeah,
we definitely need to. How does that differentiate from a build to rent profile to a build for sale profile? And how much pushback have you had from municipalities, cities, and the like?
Yeah, I mean, the process is really no different. And I think, in some respects, there's a lot of these places that don't actually restrict the ability to rent. So you could position this as a for sale community throughout most of these entitlement processes. Now, I'm not sure municipalities are going to like that when they wake up and see you renting units. And so I think we're very kind of forthcoming and open with our strategy and our goals and what we want to do. And it takes some education process, admittedly. People have never heard of this. They think maybe multifamily and, highly dense product overwhelming our schools. And so we've done a lot of kind of internal and market survey research to support what is the case, where the impact to schools is actually less significant than for sale in a lot of cases. And, the maintenance of a community with an institutional owner like ourselves is actually going to be much higher than a for sale community where you've got folks that aren't mowing their lawn or, managing the weeds. And so, it does take some time to kind of walk folks through that and why we see the benefits. But we found a lot of municipalities have been receptive to that, and particularly the ones that advocate for a diversity of product, within their municipalities.
Yeah, I can only imagine the city council meeting when somebody stands up and says, "We're not doing another trailer park," and you have to start from the very beginning. and tell that story. That's fantastic. Thank you, Cliff. I really appreciate your time and the Oxford-free story.
Thanks, Cliff.
Good luck with the platform. I'm sure you'll do very, very well. Look forward to talking to you the next time we do one of these events.
Great
Sounds
info.
great. Thanks for having me. Thanks, Steve.
Yeah.
Thanks, Todd.
Those deals,
We're gonna-
yeah.
We're going to
Yeah.
switch over the
care.
conversation to talk about managing these unique properties in this upcoming class of investments. We've got Karen Key here joining us now to talk about the challenges, the fun, the good, the bad, and how it differs from managing other types of properties. Because Karen, you've done both, am I correct?
Yes, I have done both. The bulk of my career has been conventional multifamily, and switched gears about 3 years ago to really dive headfirst into the BTR space.
I'm trying to retype your lower third. My production crew all left for the day. So I'm left on my own, and you didn't talk long enough there for me. So tell us a little bit about RangeWater, your company, profile, size, what type of projects you have.
Yeah, so RangeWater itself is a vertically integrated company. We do have an ownership, acquisitions, and development side, and then we have the property management side. I own the property management side, so we manage for ourselves for the ones we build and the ones we buy, but then the bulk of what we do in property management is third party. As a third party operator, our total portfolio size is around 85,000 units total, and that does encompass the conventional multifamily as well as our build-to-rent platform. And our build-to-rent platform today, we have about 5,000 homes that are open and active right now. But with our total portfolio that we're working on today, it's almost 15,000 homes with the ones that are in development. We are primarily in the Southeast, but we do span into the Southwest. So we're in Texas, Arizona, Colorado, Utah, a couple of states in the Southwest. We made that dive in about 5 years ago.
Where are you headquartered?
We are based in Atlanta, Georgia.
All right.
Now, I did see, I'm bringing up some slides. These aren't yours, but this is from David's presentation. But as I was talking this through, I see his organization represents 135,000 units in this, where you're at in Atlanta, Georgia, Florida, that whole market over there. I would have thought before we did this event that Texas would have been the leader in that. So do you see a lot of growth outside of your current area? Where do you see that headed?
We do. We do have a lot of growth coming in the Texas markets. Texas has actually had build-to-rent communities around for a while. They operate a little bit differently. I mean, everyone knows the start of BTR really came out of Phoenix. Those are the ones that have been around the longest. Those tend to operate a little bit more conventional, horizontal multifamily instead of just from a BTR standpoint. But there's a lot of build-to-rent communities that have been hiding in Texas for a while now that you're starting to see hit the market and trade and go into new hands. Out of our existing pipeline of growth that we have coming, I have 3 that are open in Texas today that are built to rent, but I have about 8 that will be opening by the end of this year.
Wow, you have your work cut out for you, Karen. So tell me a little bit about the differences for the people who are on the fence about getting into build to rent or own smaller portfolios, looking at growing their portfolios. What are some of the special challenges and how do you tackle them compared to a taller multifamily versus a single family?
I mean, that's a great question. You know, I would say some of the biggest challenges that come with starting a build to rent portfolio, especially from an ownership side, is these are secondary and tertiary markets most of the time. They're not going to be core infills. They're not going to be easy to travel to. So if you're starting to get a portfolio together, trying to find land that you can cluster to manage together so that you're not going to land in Atlanta and then drive 2 hours outside of the city to one tertiary market, then land in Tampa and drive 2 hours outside of Tampa to get to a different market. That is one of the biggest challenges I see for new investors into the space. Again, with them being these tertiary markets, they're often a little bit more hidden. They're off the beaten path. They may be behind an existing neighborhood, behind an existing retail center. So they're not going to get that drive-by that you get with a lot of your larger conventional multifamily deals, especially the ones that are going vertical. And then the other one is the size. A lot of these communities are small. They're not the 300 unit communities we heard about with the last presentation. They are sometimes 25, 35, 45 homes. But then, you know, you have the ones that are averaging around 100. So when you have those smaller ones, that's where I really talk about trying to get multiple parcels of land that you can manage together to get those economies of scale. Because at 25, anything under really 100 homes, it's hard to get the operating efficiencies that really bring you the return that investors are looking for in this space.
Yeah, that's a great point. Because right, how many managers are you going to have? How are you going to have the maintenance crews and things like that? Someone had mentioned to me not too long ago about construction and design for management properties. Your group doesn't build properties the same way you would build someone that's going to own it, right? You have access issues, density issues. What are some of the things, if you're brought in on the early end, you would say you have to think about these 2 or 3 things before you build?
No, that's a great question. Absolutely. You mentioned the accessibility. That is a big one. In the build to rent space right now, there haven't been those governing bodies that are saying you have to have a certain number of homes that don't have steps or don't have direct access points. But that's a great point to consider. Are you going to be able to serve, handy accessible units? Are people going to be able to enter, or do they all have front steps? Do they have a 0 threshold entry from the garage? Do you have any bathrooms that have 0 thresholds? We have one builder that he built his entire community with that in mind and made sure that all of them had a 0 threshold. So those are some of the things to consider from a design standpoint of the entire neighborhood. There's a lot of other things to consider as well. A lot of these are not amenitized. They don't have a club room. They don't have pools. They don't have fitness centers, which is perfectly fine. That's not the driving factor for a lot of the renters in the build to rent space. But one thing you don't think about is, where are you going to keep maintenance supplies? So if you don't have any common areas, are you going to do a nice shed somewhere to just house some supplies and some equipment so that you have things there for your teams when they are on site? That's probably the number one missed thing, is we forget to program where the maintenance shop is going to be. For the units themselves, irrigation has been a big topic that comes up lately. Are you going to irrigate the lawns? And if you're going to irrigate the lawns, how are you going to do so? Are you going to do it as a meter per home and then have it billed with their water and then risk people turning it off? Are you going to do a master meter for the entire neighborhood? And then there's some where they're doing 1 meter and splitting between 2 lots. All of that really needs to be thought through with the city in mind. Different municipalities have really dove in on how they will let you do irrigation meters in case there is a potential to do an exit of individually sold homes. If you have meters tied together, but the homes eventually sell as individual homes, how does that work? So there's a lot of local water companies getting involved with irrigation meters right now.
And when I said accessibility, I meant both, but that was my thought too, was if I've got to go in and work on the water softener, am I coming in the front door, or do we build an access door because it's a for rent place? Maybe there's all these things that I think people haven't thought about yet.
And that is a great point. That is actually, I had that conversation with a client the other day, is there a way we could program where the water heater was, the HVAC controls, everything to where they could have a separate door? And kind of like a riser room in a mid-rise, right? You go into that riser room and you can access all the controls of the home and you're not having to come into the house itself. That's a great point.
You got to remember, if you're in Minnesota or Chicago, like Cliff was,
Hey, Todd, I had a
they'll
quick
freeze if you put them on the outside. Yeah, Steve, go ahead.
Yeah, Karen, thank you so much for the time. Great information on this. On the management side, in terms of leasing, what are some of the latest leasing tools that you use, these remote areas? How are people finding you? And are there some great latest leasing tools that you guys are using?
That's a great question. Again, I talked about the size of these communities, and a lot of the times they are on the smaller unit count for us in particular. So we can't have a large team there. So for our leasing tools, I'll start with the leasing and marketing side of things. We take an approach where we really market to both aspects of the renter. We are marketing to the ones that are looking for apartments, and we're marketing to those who are looking to buy a home. Because right now, a lot of what's going on out there is educating consumers that this product type even exists. People don't know yet that this is an option for them. So, we are looking to figure out how can we attract both of these sides to make sure they know we exist and they're not having to live in an apartment just because they know they have to rent, or they don't think that there's any solution outside of buying a home if they're struggling, because in today's market, the homes are few and far between. So we do a lot of SEM campaigns and a lot of internet campaigns that are driven to attract both of those pieces of traffic. This is a very internet driven sector. People are searching for it online. virtual and self-guided tours are crucial here. People are doing it on their own time, and that really does help with the payroll, especially in the remote markets. You're able to be open 7 days a week, almost 24 hours a day, and you don't have to staff it as such. So where self-guided tours have been growing in popularity in multifamily over recent years and really spiked during the pandemic.
Do they find you
in the
through one of the
build-to-rent
big
space,
sites
it's
like
crucial.
apartments.com or something like, or is that all, what's the sites that drive them to you? What's been the most successful for
It
you?
does vary a little bit by market. Apartments.com has consistently been a top performer
'Cause, you know,
for
we
us.
had CoStar on here before. We got to give them a little love.
They do. They are one of our top performers, especially because the way they do tie into pulling from the rental side for the scattered family houses. They allow them to advertise on their site. So it does give us that ability to get that visibility through apartments.com. And it was just announced recently that Rently, who is our go-to provider for self-guided tours and
Rently.
smart home platforms, is
Right.
partnered with apartments.com, and you can schedule it all seamlessly through there.
All right. Yeah, we've seen some.
We've got representatives from Yardi online too, and a couple other of those. Well, next time we do this event, Steve, we're gonna have to bring in some self-guided tour companies and some listing agencies and talk about go through some demos.
No, great info, Karen. I was really curious about that.
Karen, tell me this. What's the one thing we didn't cover today in regards to management that we have to know before we sign off?
Oh my gosh, the one thing regards to management, I would say the biggest obstacle you're going to have in management is getting that database. There isn't a CoStar yet for the build to rent sector that is completely comprehensive of the build to rent communities and the scattered single family rental market. So there is a lot of manual research that has to be done by your operators that takes a lot of time. So it's not as easy to get the deep dive analytics that we can get in student housing, multifamily, senior living, because that database just doesn't exist yet. I know there are groups like CoStar that are working on getting that together, but you know, it all depends on how these communities are listed in the beginning. Some build to rent automatically flow into CoStar because they list themselves to be apartment living to also get that popularity. And others stay under the radar and they don't want to be noticed. And so you have to go search for them. So I would say that is the biggest challenge as an operator and as an owner, knowing that it's harder to get that deep dive in your analytics because you have to figure out where it's coming from.
I thought for sure you were going to say having to get in your car and drive miles and miles and miles instead of being in an office in the building.
Well, there's that too. But luckily, we've been able to have people geographically situated for our community. So they are more challenging to get to, that is for sure.
Todd, I got another question. When you're doing third-party management, what's the biggest difference between doing third-party management for a build-to-rent property versus a traditional apartment building?
Oh, you know, I would say in terms of that, I don't think that there is a big difference in just looking at it in terms of multifamily or build to rent from a third party aspect. I would say as a third party operator, you know, if you take the specific client out of it, when we first started out, I would say we were 80% client heavy on clients that had never been in any form of multifamily at all. Now we're closer to 50-50. So from an operator standpoint, it was a great learning experience from us. We were getting to learn from home builders. We were getting to learn from lot developers on that process of building a neighborhood, because that was completely foreign to us. But it was completely foreign to them on anything multifamily, anything rental, fair housing laws. So it was a lot of give and take. Now we're about 50-50. We've got a lot of multifamily players that have come into the space. A lot of our standard institutions have crossed over into the space, but we do still hold on to those home builders and lot developers that are brand new to anything rental.
Good answer. All right.
Excellent. Good stuff. We are going to switch over now. Karen, thank you for your generous time. It's amazing that you all manage, I think you said 85,000 units between vertical and the single family space. That's an astonishing accomplishment, and the growth sounds like you're going places. So thank you for your time. Look forward to talking again.
Yes, Todd, Steve, thank you so much. Y'all have a great afternoon.
Thank you. Great job. Great info.
All right, we got Jim Lockhart, Kevin McHale, not to be confused with the basketball Kevin McHale, but I bet this Kevin McHale can shoot the free throws or 3-pointers as well. We're going to talk about, we're going to throw a little bit of a curveball, Steve, into the conversation. And because I want to save the people, this is my old career in taxes and real estate, save people the headaches of making mistakes or missing out on benefits in this build to rent discussion. So Jim, Kevin, welcome. Do you want to introduce yourselves real quick? Tell us who you are.
Sure, Kevin, go ahead.
Sure, I'll start. My name's Kevin McHale. I'm a senior tax manager with Anshin Block and Anshin. Anshin's a mid-sized firm based out of New York City with offices in Boca and Long Island. We have roughly 400 professionals. Jim and I sit in our real estate practice where we focus on multi-generational families, syndicators, owner-operators, management companies, over all real estate classes. Most of our clients have properties all over the country.
Jim?
Right. Yeah, and my name is Jim Lockhart. I'm a tax partner at Anshin Block and Anshin. Just recently joined them. Just a wonderful, sophisticated real estate practice. Like Kevin said, we have clients all over the country, and it's just been a pleasure to work there, work with Kevin, and looking forward to our discussion today.
So we're going to do, we decided to do a little role playing. And we're going to do a couple scenarios, and then like I think Jim said, we're going to branch off just a little bit. So I'll try to help us stay organized and translate some of the tax terms. Might get a little bit heavy, but they're super important. So this is an important time to, if you're watching this and you got other things going on like your email or your laundry or whatever, pay attention to this segment because it could save you a lot and create opportunities for you. Okay, so the first scenario I want to talk about is we've got farmland. Grandma's passed away or soon to pass away, and the family wants to move on from this farmland. We're considering a build to rent scenario or a single family home scenario or just a sale of all the lots to a single developer. What are my concerns here at this scenario? What do I need to be thinking about?
Well, if Kevin, if I could start this and jump in as always, but basically when you're going to go sell the farm as to a developer, right? You're automatic. What you're concerned with is your exit strategy and taxes, right? So if you're selling the farm to a developer, it's like how do I preserve capital gain treatment, right? So if I just sell straight to the developer, I can get capital gains, or I can enter into a like-kind exchange, defer the taxes, and invest in other types of real estate.
Okay, so there's three ways I could go wrong here, right? One would be ordinary income. That's like double the tax of capital gains, right?
Yep.
Capital gains would be half the tax. 1031 would be no tax due now.
Right.
Kick the can down the road by buying some more real estate.
Right. Right. But if the developer comes to me and says, hey, contribute your land as equity into this development, right, and participate in the upside, which you have to be concerned about is now, did I take my capital gain property and turn it into ordinary income property? Because the traditional land development, housing development, whatever, now you've put it into an entity that's going to create inventory and sell off lots. And now you're in an ordinary income types of situation.
Because now I'm in the business of selling lots, right?
You've now entered the business into selling the lots.
Okay,
Now,
so Kevin, is there a way around this?
So if you were gonna go through with the business of selling lots, what you might want to do is try to get the appreciation of the land out. A way to structure that would be to sell it to a related corp as a development entity. That at least could preserve the appreciation of land as capital gain. The upside might come through as ordinary, but that would save a lot of taxes. And the one thing that corps have is they're not subject to self-employment income. Developers on top of the ordinary rates could have self-employment issues if they were to leave that in a partnership.
So not just twice the tax, potentially even more than that. So I've created a separation in time. I've said, hey, this is my timeline. From here, it's development. And from here, it was investment prior to that. Does that work, Jim? What are some of the other concerns?
well, yeah, well, it works. And because you really have two issues. One, you have your exit strategy, but if you decide to go into a business, you have income during the time you're in business until when you make that eventual sale. And so you have tax considerations about that. I like Kevin's idea if, to preserve that capital gain, but if you go into a C Corp or an S Corp, and the developer will tell you the same thing, you don't get your outside basis through debt financing on the land, and you're not going to get as many losses, paper losses, to offset income during that period of time. And so you've kind of changed the nature of the tax situation going forward while you're operating. So we always recommend, to the extent possible, being in a partnership or an LLC where you get outside debt basis. So when you do things, you're able to offset current income.
So we just bifurcated, people, if you were paying attention. We just came up with two scenarios where, and this is on the development side. I'm shuffling the board. I'm playing Monopoly now. And I'm going to either rent these properties and hold them long-term, or I'm going to sell off the lots to maybe different builders, maybe all the same builder, but selling them off one at a time. That's definitely a development activity, right? And
Yeah.
ordinary income, and you're gonna pay a lot of income tax, but that's the lay of the land if you do that. If you do a build for rent community and build all of the houses and have one big portfolio, you want that depreciation and such, right, Jim?
Oh, yeah, absolutely. And so, what, we do with our developers that, invest, build, and hold, we do such things as cost segregation studies. We do 179D studies. Kevin's wrote down a whole list of other things that we can do to accelerate tax deductions. We're able to shelter that income, for an extended period of time, while you're in that pre-sale operating phase, to take out cash tax-free, right? So that's what the advantage of is, to build and hold and then to rent out. So that is something that we do with our clients. Kevin?
Yeah, and the nice thing is if you put that in a partnership, you can actually refinance the properties as a increase in value. It's a way you could take the cash out without recognizing any gain. The debt from those refinances should really follow the cash, that you're not going to be triggering any tax.
Right. Right.
Well, the 50% bite in some jurisdictions that you're going to give to the government really hurt a person's profits when you're in the real estate business. So I think a lot of people that are watching this show, either live right now or on YouTube, have flipped a house before, or they've owned an investment in real estate or a property or a building or an apartment building, done a 1031 exchange, or at least thought about doing a 1031 exchange, and been good at kicking that can down the road. That's one of the things that makes real estate really an attractive investment. So Kevin, what is available to that investor? You talked a little bit about some depreciation items, but how does that work with the 1031, and how do we really create a plan to not become that dealer and not have to have that 50% bite taken off?
Sure. So investors are eligible for, as we stated, 1031. They can also roll their investments into opportunity zones. For now, that they have until 2026 before they have to pick up the capital gain. They might lose out currently on some of the step up and basis investments, but it still could be an attractive option. Investors can also issue notes and go into an installment sale if they wanted to finance the seller's acquisition. For dealers, none of this is available.
Right. And I might add, as far as doing 1031s, we also have UPREIT transactions. We have all sorts of options. We have DSTs. So, if we want to do a 1031, there's a lot of DST funds out there, especially for someone who's selling a farm, right? They've done this. Hey, I've taken enough risk. Now, maybe I just want to go to the bank. I just want to go to the mailbox, get my check. I roll it into a 1031 type of fund. So there's so many options out there.
Tell me some specific stories. I've heard the horror stories. What, do you have any? Did somebody come to you too late and whoops, or what are some of the things you've had happen that people should avoid?
So we actually had a client who who actually changed his intent. We were able to get them to convert from dealer status to investor status. One of the things is that if you do change your intent throughout the ownership, the courts have ruled favorably in the taxpayers' favor that they could pick up capital gain. We had a client that they were doing a build to sell. The deal kind of fell through and didn't materialize. They converted that to almost a build to rent strategy. A lot of it's fact and circumstance driven. They got a new agents, they got new brokers, they changed a lot of their documents for their funds. But they were able to really convert, would have been almost a 50% tax bite into a capital gain asset upon liquidation.
That
Right.
one has a happy ending.
They are usually, well, you try to structure them to be a happy ending, and it like Kevin said, it just depends on intent and facts and circumstances. And we have people go down certain roads that say, hey, I do hold this for investment and this is what I want to do, and just kind of the opposite. Whereas, hey, they get an offer that they can't refuse, and it's like, did I hold it for the requisite period of time to get that capital gains, or treat it as an investment property? And, you just, you can pretty much do anything if you have enough time, in between when you sell or you think you're going to do something and when you eventually do. But, it's, you really got to consult with your tax advisor as to, what's the best path to take. Because like you started out, Todd, there's a couple, 2 or 3 different paths you can go down, and you just have to structure things right up front. So just in case we happen to take another turn, that we don't stub our toe in the process.
Steve, I know tax isn't your area, but you got any questions for our tax guys?
I do, because I'm a marketing guy. That's all I think about is marketing. Who's your ideal client? Big company, middle guy, smalls, growing. What's the ideal client for your firm?
Well, Kevin, jump in here, but our ideal client is, we have we have lots of developers, we have lots of funds, we have very high net worth families. So, we take on all size of clients. I don't think we have a minimum threshold for a size of client, but this rent topic that we're seeing here, we're seeing a lot of, and we're those are fairly substantial developments, and it takes a very sophisticated tax advisor to handle it. So I think anybody who's listening to this and thinks they want to enter into this type of venture really needs some very well thought out tax advice.
That's for sure.
Kevin, what do you think?
No, I agree with that. When you really drill down into the regs surrounding all of this, I mean, it gets very specific with like types of improvements. What are you doing? If you get the taint of dealer status, and that's kind of what you see, it's really a taint. It could have very adverse impacts. Typically, you don't want dealer status unless you're dealing with a loss situation, which is ordinary. I would say, like Jim said, we deal with a lot of sophisticated clients. We also deal with some smaller clients that really need some hand-holding. If this is the first time we're going through this, we have platforms for some, smaller businesses or first-time kind of business ventures in this field.
All right,
right. I would say, especially if there's brokers or developers out here talking to first-time people that are selling their land or they're staying in the deal. You really want to make sure that they get the best advice.
Right, and get in as early as possible with you guys early, so you don't have to fix things halfway through, right?
Oh yeah, absolutely. We're very proactive with our clients, talking to them all the time, because the last thing you want to do is have them say, talk to you about a transaction after it's happened, and then you kind of have to go back and
Right. Are there states that present more problems to the clients than others? That you have more clients coming to you with issues that any particular states besides the one I'm in, California?
I don't think, it depends on the state, like certain states, for instance, like a state like New Jersey where I am, if you end up producing capital loss property, it's a user to lose it in that year. So there's just certain considerations that you got to think about
Right.
when structuring these deals, what the economics are.
Yeah, and that's true. I mean, you really can't help what state you're in if, there's a piece of land, right, located in a state. You just have to be aware of the state consequences, but the federal tax consequences are a uniform.
Right.
And so you can pretty much handle those no matter where you're at. But, you should be working with a firm that does have a state and local tax group that understands, with a firm of a national presence that can help. And, we certainly can.
Yeah, having the combination is key for sure.
Yeah.
Leading into. Thank you,
We
guys.
gotta keep rolling, gentlemen.
Yeah.
Thank you, Jim Lockhart, Kevin McHale.
Thank you.
I know there are people watching online right now who are like, please don't talk taxes again. My eyes roll back in my head. It's painful, but I just have heard of so many horror stories and watched them happen. If you don't bring these guys in at the beginning of the process, when, some of the guys we've talked to were out, Cliff Payne out looking at raw land, bring in your tax advisors for both sides. Make sure that you cross the T's, dot the I's, because it could lead to adverse things right away.
Yeah. I would just make, Todd, if I can, just, one more comment, because, we have so many clients that, try to defer their taxes, avoid the taxes because, paying a hefty tax bill, trying to make up that equity down the road is just so hard. And so we can help structure things to avoid that, so you keep as much cash as possible, and especially as you start operating. So.
Great advice. Thank you much. All right. We're bringing in
Thanks,
Todd
guys.
Wood now, Christopher Todd Communities, very successful developer, as a unique platform. Todd, why don't you just start off just telling us a little bit about Christopher Todd and what you're trying to accomplish?
Sure. Thank you. And thank you again for the opportunity to be here. We started our platform really about 6-7 years ago, before BTR was anything. Nobody really understood what that was. I remember when somebody came out to the Phoenix area and they looked at it and they said, what is this product? It's a horizontal multifamily product, single story, rental community, luxurious. We're just going to call it, for a better sake, build to rent. And we've been calling it build to rent for the last 7 years. Now that has taken on a much broader brush and a much broader interpretation of what is build to rent. So we're one of the very first pioneers in the market in bringing this new product, which is a single story horizontal community, home community, to the market. It is not your traditional vertical multifamily, and it's not your single family rental. It's that right in between. It's a hybrid product that people would be able to come in and rent a home and have all of the amenities that a multifamily development would bring to them. One of the things that we provide are private backyards. We think that is something that most renters really endear. We're very pet friendly. Every one of our homes have a doggy door. So this is a concept and a product that has gotten a lot of traction over the last couple of years. People have seen it. We've been able to go in, and the demand has been so strong that our rent rates are traditionally higher than most traditional Class A multifamily products. So we've been able to keep our costs very minimal. And what we've done is we've developed a platform which is a branded platform, where our communities are highly branded, highly amenitized, and we provide all of this luxury living. One of the amenities that we provide besides backyards is home technology. We probably brought in some of the smartest home technology available, so that at a click of a button, whether you're at your car or your office, you can sit and look and see your camera and look down and see how your dog's performing during the day. Most of our communities are gated communities, so you have that privacy. and that security and that safety that a lot of people are seeking for. So with that, we put together this branded platform, and we've gone ahead and we've joined up with Taylor Morrison. Taylor Morrison is America's most trusted home builder. I think they've won that 7 years in a row now. And we're moving that platform across America as we speak. We have products that we're putting up in Phoenix, Dallas, Houston, Austin, Tampa, Orlando, Jacksonville, Charlotte, and many other areas that we're looking at opening in the near future. So as we, it's a national platform as we move forward. What we're able to do, we bring services to not only the developer who's developing the product, but we also bring services once it's ready to transition and be sold to a second generation owner. Then we bring all of these rich owner services to that buyer, services that they just can't get anywhere else. Oftentimes it's an immediate cost discount that we bring in our national vendors, and by using Christopher Todd, they immediately receive a discount on some of their services for the community, and also many other services that we provide at a discount to our owners. So as we move this across the country, it's proven to be a real nice model.
What's the size threshold for being a Christopher Todd community? Is it 100 units and greater, 300 units and greater? What's your sweet spot?
Yeah, great question. Sweet spot is really about 200 units plus. We've gone down to as low as 140 units in a community, but our sweet spot is really 200 units plus per community. You know, we try to look for anywhere from about 15 to 30 acres as we go out. Oftentimes, one of the great things that happens is when we find a developer, whether it's a master plan and they've always got a dedicated piece for multifamily product, and yet they don't like this vertical product that goes up. It's kind of the big box and everybody looks at it and they just plant big trees around it to kind of hide it. But, you know, they want some density. Our density is about 12 units, 12 homes per acre. And so it's a nice buffer between us and a traditional vertical multifamily. And these planned communities can come in and then they can plan bringing in a really nice, high luxurious single-story living community.
Todd, do you also do traditional multifamily?
We do not.
Just the build to rent and single family rent?
That is correct.
Exclusively. That's rare. That's unique.
Well, sometimes it's good to be a master of one thing rather than, you know, pretty good at a lot. So we try to be professionals and experts in one key area. And there's just a lot of runway and depth to this product.
Now it looks from and it sounds like you're going after the luxury segment in this particular market. Is that a fair read on it?
That's a fair read, yes. We're a Class A multifamily luxury community that we bring in. That is correct.
That's also a bit unique for the build to rent segment in terms of the scale of amenities and finishes. Is that accurate?
I don't know if I could honestly answer and say yes.
Because it seems like a lot are geared towards the middle or, you know, lower end of the rental market.
When you talk about multifamily, I have to group ourselves in the entire multifamily class, not single family rental. That's a different class. But we really fall into multifamily. And as we go into municipalities and jurisdictions, you know, they look at us and they say, well, wait a minute, these are small individual homes, so it must be single family rentals. But you're managed by a professional management group that's on site, so that's really multifamily. They really don't know what we are because we're this hybrid, but we're really truly a multifamily product. So if you put us into that multifamily category, you look at some of the Class A vertical multifamily products that are out there, there is an amenity war that is going on right now. And they're just throwing amenities at all of the residents, hoping something sticks.
All right, give me an example. Give us like some, off the brand new amenities that people are throwing in there. Out here we got the dog parks and the dog washing areas and the new rooms for the deliveries and all of that.
Oh, it's more like if you could look at the hospitality. So there's now wine tasting rooms and there's massage therapy rooms and concierge services that they'll bring in. So they're really trying to upscale that amenity for that because it's very competitive.
Right.
So we try to stay very resident focused. And if we're looking at a resident, our residents are very different than the resident that lives in that 3 to 4 story vertical product.
Right.
So our residents are looking for something different. So as we stay resident centric and we look at what do our residents really want and what do they need versus what's their wish list, and let's just build it and hope they like it. And so that's what we really focused on. And those are the amenities that we'll bring into our residents to ensure that they have that luxury living experience that they're looking for.
So what is your resident profile? We had heard the move ups from a couple of speakers earlier. So people moving from student housing or from their first apartment on up to the community. Is it a different demographic or do you have a specific demographic?
It's a great question. So if you think about what our product is, which this is this horizontal single story little home with a backyard, professionally managed with luxury amenities. And our demographic really falls into 2 large categories. One is that millennial group. So about 60% of our residents are under the age of 35. And they're a very professional 35-year-old and under. They're 80% of them are college graduates. We have one community where we have 90% are making close to $100,000. These are rent by choice individuals. And if they want to have to rent by choice, then they want to find the product that they really enjoy renting, not just what's available. So they've sought out and they've looked at this product and says, wow, I don't have to climb stairs. I don't have to take my bike up and down the stairs. I don't have residents above me and below me to the sides. We've solved the #1 problem in multifamily vertical renting. #1 problem, acoustics. So everybody complains about it, noise. I hate my noisy neighbors. So we have this standalone home that's insulated, that has space around it that solves for that problem. The other percent.
Let me ask a quick question on that one. Is that pre-kids, like singles or couples before kids?
Yes, almost 95% of them do not have children.
Gotcha. All right.
So a lot of our communities, for example, you go to the multifamily communities, and one of the amenities that they're trying to bring in is they bring in all of these playgrounds for children. I don't think we're going to bring that in because we just don't have children in our communities. Very few children are in our communities. The other demographic are those boomers, and the boomers that have either lost their home or sold their home or downsizing, and they want a lock and leave experience. They want the flexibility of saying, gee, I want to live by one of my kids, but I have another child that lives across the country and I want to be able to just get up and move and go and not have to worry about the yard. I don't want to mow it. I don't have to worry about my dog. It's taken care of. And it's really a nice experience for them.
Mm-hmm.
I'm glad you brought up the yard, Todd, because we have a question online. A very active chat room for when you came on, by the way. So a good sign. How are your backyards maintained from a lawn mowing maintenance perspective?
It's a great question. We at this time have put in artificial turf. We think that's a good alternative at this moment. It's got a lot of green aspects to it, and we oftentimes will promote that. We do have other areas where it's either a granite field with shrubbery or a shaded tree in the backyard. But at this time, we're putting in artificial turf to keep down that maintenance.
That is brilliant. And then there's one other question. How many square feet? What's the size of your units that you're
I was just gonna ask that.
targeting?
Yeah, sure. You can get online at christophertodd.com and look and see what our unit sizes are, but they're around for a single story, they're around 700 square feet and single bedroom around 700 square feet and 2 bedrooms around 1,100 square feet for 2 bedroom. And they'll have, a nice luxurious bathroom, shower, tub, living space, kitchen area.
Impressive. Couple other things since we're almost out of time. You've created quite a product here, and you've been in the space for long enough to really have worked through some of the difficulties that maybe other people are just getting in have to deal with. What, Todd, keeps you up at night? What's your biggest worry for the future of the build to rent space?
Yeah, great question. Probably my biggest worries is the knockoff wannabes. That is, we're trying to build, let's say, a Class A, a Marriott or a Hilton type product. And we're going to have all of these Holiday Inns come along, which will be Class B and Class C and want to be and perform like a Class A. And I'm a little worried the reputation that will start to tarnish what we're developing at the current moment. There's a couple of developers like ourselves that are developing really nice, high, good quality product. So I worry about the municipalities allowing that. Now, municipalities are always screaming for, affordable housing. They look at this and say, oh, this is really great. Can you create affordable housing for us? And we say, this is just not an affordable housing product. You'll have to get another developer to do that. Well, nobody wants to do it. Well, there's some reasons why, affordable housing is very difficult to produce for municipalities, but that's not where we're going. And so I think that's probably one of the main things that keep me up. The other thing that keeps me up at night, there's two. Cost of construction. That's everybody's worry right now. Lumber's come down, which is, a nice relief to the developers and builders, but cost of construction is difficulty. And sourcing and that supply chain issue, that's also difficult. So here you've got a product that you're traditionally, let's say you can build it in a year and a half. You can get in and get out in a year and a half. It's now taking 2 or 2.5 years. So you've got this longer build cycle, which is, time is money. So that's very difficult because this is a new construction product.
Todd, I got a couple quick ones.
Okay, go ahead.
I was going to ask you, Todd, what geographic areas of the country, are you mostly in, where your major projects are? And how do you find new projects? And do you partner, or do you have to buy outright, or do you partner with folks? So geographic areas where you see growth.
Great.
How do you find new projects, and will you partner with developers, or do you got to own it outright?
Yeah, we like to, of course, some of the hot spots right now are in the Sun Belt states, the Southern Sun Belt. So we kind of look at the Smile states, from West Coast to East Coast. It's going to be a while before maybe we get up into the Northeast. We're not really, we are looking at some California areas. We've looked at that. But, we'll probably try and saturate that Southern Sun Belt first, and then we'll start, proliferating in the rest of the United States. There are little hot pockets that you need to look at. We're also taking a look at those. I think your next question was, we right now currently are building with Taylor Morrison, and we're doing that. And we also look for, many other opportunities as they come our way. There are developers and also landowners that are
I was going to say a landowner who doesn't maybe want to sell, but wants to be a part of it going forward. You'll talk?
Absolutely.
All right.
We'd love to talk to them and see how we could come out there and put a Christopher Todd, property on their land with them for them.
All right. That's flexibility that sometimes you don't see. Good to know.
All right, Todd Wood, great to get to know you. It sounds like an amazing product. I'm kind of jealous because your platform's so built out so well. I got to ask you one quick thing before we jump to Andy. Somebody in the chat room noticed you don't have garages. Can you make a quick defensive position for why that is a decision?
Sure. If you look at traditional multifamily, most multifamily do not have, it's just open space parking. Some of that open space parking might have covered parking, which we also have as well. In a lot of our developments, we have anywhere from 10 to as much as 18% where we kind of have a off-site garage. So we do have garage parking, which allows for inside garage parking. So we do provide that, and depending upon the community, that could go up to as much as 30% would be garage parking. Other would be covered and uncovered parking. And that's just a method of making sure that you maximize the space available to get as much density as you can.
Yeah, that makes a ton of sense. I really like that idea, and hopefully you do really well with it. Let's move on.
Thanks,
Todd,
Todd.
thank you again. Appreciate your time. Very generous
Thank
with it.
you.
Thanks for having me on. Good luck.
Yeah, thank you.
You too.
Okay, we've got Andy Zhu. I hope I said that right. Pentagon Holdings. Thanks for joining us.
Yes, you did, Todd. Thank you.
Yeah,
Andy.
tell us a little bit about yourself, Andy, and Pentagon.
Would love to. So my name's Andy Zhu, everybody. Thank you for joining us today. Director of Business Development for Pentagon Holdings. We are a BFR, single family BFR and multifamily and mixed use developer based in Nashville, Tennessee. We've got projects going in Nashville and Huntsville, Alabama, looking to expand to the Florida and South Carolina markets over the next year or so. We have 1,600 units under contract or purchase to be developed. We're doing all ground up development, no existing acquisitions. And the status of us, and hopefully we can even tailor some of the questions that people will be asking for us compared to someone like Todd, is we essentially emerged kind of out of stealth mode over the last couple of months. We're now really building out our branding and marketing, but we got started at the beginning of last year, really just tying up land deals, putting all these contracts together in order to make a really big push all at once. So now we are going vertical on several of our projects here shortly, having started horizontal as well on a lot of them. So we're really in the BTR space, a startup, but we come from 30 years of experience. Our CEO has led the divisions for Lennar, Taylor Morrison, K. Havananian, Toll Brothers in regions around the country. So we bring a little bit more of that traditional single family home builder experience into the real estate and private equity development space.
So what would you say to somebody who doesn't have that experience? What does your experience provide? If I came from just purely, building towers of multifamily into this space, what things do you do differently?
I think a couple of the ways that we approach it differently is, I think the first thing on the entitlement side. I know a lot of and we just heard, right? A lot of traditional multifamily developers are going to go in and look at this as a completely multifamily development. You're kind of pitching the communities as such. One of the key ways we are trying to operate our business model is to have our homes and the product that we're designing for the build to rent space specifically. Obviously, we're working on multifamily deals as well, and those are just, traditional multifamily. But the way we're positioning our business model is that we don't want to necessarily be stuck in having to do single family rentals as our only exit strategy for the product we're building. So when we go in and we're building out a community and we're scoping out what kind of programming, what kind of amenities, what kind of layout we want for these homes, we're making sure that, hey, I don't know what's going to happen necessarily in 2 to 3 to 5 years. Nobody does. I mean, we all are here today because we believe in the future of the space, but we want to make sure that we have multiple exit strategies. And one of those strategies is being able to sell these homes on an individual lot basis, an individual home basis to an end user buyer. So all of our product that we're designing is designed to be individually platted homes that we are having all together in one community, but giving us the opportunity to potentially exit to that should something happen regulatory wise, financing wise. I don't know what's going to happen, right? But let's say cap rates go up 200 to 300 basis points for whatever reason in the space, and all of a sudden the pro forma exits don't pencil, but it's still okay to be able to sell to an individual home buyer. That's kind of how we're approaching it. And one thing that I will consider telling people that this is the advantage of going into the build to rent market, single family build to rent market, that people may be missing out on if they're not bringing this perspective to the table. They're only focused on thinking about it as traditional multifamily, but spread out as horizontal apartments.
Well, Steve had asked Todd Wood a similar question, but where do you fall on the spectrum of luxury versus mid-tier? Or I'm assuming you're building new, you're probably not building anything Class C. That doesn't really make sense, but where do you find yourselves on the higher end structure?
I'd say we're building B plus or A minus product. We, as a developer, we're trying to target the middle market and above for what our product is, trying to span the range of kind of the beginning of the working class to kind of the upper middle class is really our target, with the more traditional single family product than, you know, Todd may have been talking about. We do put 2-car garages in our product, have the traditional lawn and backyard, kind of more traditional lot sizes based off of the municipalities that we're going in as well. And that probably has a lot to do with the types of product we're designing, because a lot of communities aren't going to allow us to go to the, you know, 12 to 15 units per acre that Todd might be able to get in certain spaces. A lot of our communities are going to be zoned on a traditional, you know, R6 zoning, R9, R10 zoning. And so we're going to get much, much less density out of that, which is going to be more like 5 units to the acre, even down to 2 or 3 units to the acre. So the product we're designing is really more the traditional single family home that you think of in a suburban environment, but specifically geared and made to rent for people. As far as the finishes that we're doing all masonry or hardy board siding, quartz countertops, kitchen backsplash, you know, tile master bathroom shower, luxury vinyl plank throughout, no carpet, 9-foot ceilings first floor. So I would say that's a pretty high-end product. And that's why I say it's probably A minus. It's not decked out to the ultimate super luxury studs on every single line item, but I'd say we're better than a lot of the product that even traditional for sale home builders are putting out there.
I'm sure it's throughout all the markets, but just curious, what's the average new home cost to build for you guys all in?
So let's say in Nashville, where we're building, our product is between, for single family homes specifically, we do single family homes, townhomes, and kind of 1-story age targeted villas. For single family homes, we're building between 1,400 to 2,200 square feet. That's kind of where we found was the sweet spot in market analytics, because you start to get bigger and then you kind of have some diminishing returns in the amount of base rent that people want to pay. Obviously, it's the same thing of why people try to make smaller unit sizes in general in multifamily, but try to have more units, right? You're going to be able to get more money out of a studio apartment per square foot than you are out of like a 2-bedroom per square foot, right? So that's kind of been the sweet spot that we've been targeting, just depending on the land cost of where it is. I'd say we would be selling our product anywhere between $300,000 to $400,000, kind of on the lower end. And then once we're into the higher 2,000 square foot plus, it's going to be in the 400 and plus range, just depending on the land cost, which puts us competitive. We're trying to aim for positions that allow us to build this product right at the median home value for the area. the median home value for Nashville is now a little bit above 400. So that's where we're trying to target.
What would the rental be on the average home?
The rental on that average home is probably $1,750 to $2,000 in that range.
Gotcha. Now, have you sold any of the complexes that you built?
No, we have not.
Oh,
We have not.
gotcha.
Let me go a different direction than what we've gone at all today, is construction methods. Have you looked at, my mind goes to like modular, and then my mind goes to city council saying you're building a trailer park. What are some of the construction methods, things you've done, economies of scale, anything like that?
So in terms of just managing construction sites and managing and best practices in order to and bringing that home builder specific experience, we're doing things like ordering all of our windows ahead of time. Like for our first community, we ordered all of our windows like 3 or 4 or 5 months ago, and then locked in a really good price for them. Thankfully, some of those supply chain issues are getting better. Lumber obviously has gone down since its peak, but other things because of oil, right, and asphalt and paving and all those things are going back up. So these construction costs are always in flux. The things that we're exploring, to your point, Todd, on the differing construction methods, one of them is we are looking at panelized construction, at least for the exterior walls, right? We've talked to several people about it. We've talked to a few operators in the modular construction space as well. The difficulty, obviously, is that that's a conversation that you have to have a year to a year and a half ahead of time before you start building. Otherwise, the time it takes to retool manufacturing lines and all that kind of stuff, it really just does take a long time. And a lot of those guys who are running good modular construction facilities, they have backlogs forever. And where we are based out of the Southeast in Tennessee and in Nashville, we don't have as much access to modular construction factories as they might out on the West Coast. So those have been some of the limiting factors to us there, but we are very interested and have been exploring and are in talks with a lot of those guys, because that's where you can, like, if we even get a couple percentage points off construction costs because of modular, or just speed up the timing process by a few months, that's such a big advantage to the product that we're trying to build. Building 1,600 units is a lot of units, and we're, as much as we can speed that up, we're looking at every available method to do that.
It'll be interesting to see how that plays out. So how have interest rates affected you all?
So that's a fun question.
That's a big reaction, because that's how I feel every day.
It's like, for the past, looking at the performance that we ran last year and the performance that we're running now, it's almost laughable. Just when people were saying, yeah, you can get a construction rate still at 3, and your permanent takeout might be as low as 275, and now looking at the things we're underwriting kind of at a minimum construction costs at 5.25, 5.5, up 200, 300 basis points than even though we were, right, permanent takeout. Sometimes I'm writing, which is crazy, I'm writing my permanent takeout at a higher rate than my construction. And that's just because I'm looking at the forward curve and I'm saying, well, the forward curve is going to be higher a year from now, and a year, 2 years from now, or whenever I'm trying to go into permanent debt on this product. And so somehow my permanent debt might actually be more expensive than my construction debt, right? And you can always get around that when we're having a conversation with our banks of looking at trying to get fixed in that interest rate now, or whether we're trying to do floating rate debt. And the answer is, I'm talking to all of my other colleagues and friends around the industry, this is just something that we look at every day. It's definitely increased the cost of capital for our capital stack and made us more conservative on a lot of our projections. What it's also done, thankfully for us, and less thankfully for some of our competitors in the space, is that it's kicked a lot of deals off of viability, at least on the price points at which people bought half a year ago. For example, we had what my boss likes to say, what Blake Seeberger likes to say, he likes to say that sometimes you wish you came in second place on a deal. And what we're seeing is that a lot of the deals that we made an offer on half a year ago that we came in second place on are now coming back to our desk and at a lower price. And they're like, hey, do you guys want to still do that same price you had half a year ago? And we're sitting there, it's like, well, not anymore. It's too late. You got to bring that number down a little bit more. So because of those interest rate issues, and I think people's fear of recession and all that kind of stuff as well, that is causing a lot of deals to come back around to us and some repricing on the land side. So that is beneficial for us because how we try to underwrite and stay fairly conservative on the underwriting, which has to meet the restrictions of being able to be profitable both on a build to rent and a build for sale model, so that we're trying to cover all of our bases, is that we're getting a lot of the benefit of seeing actually a lot more deal flow from canceled deals than we had half a year ago.
I got a follow-up or two to that, Andy, and thanks for sharing. Do you buy deals that are both built as well as, ground up?
No, we're not buying any existing product because that's where we have some operational, that's what we consider to be our competitive advantage in the entitlement side, because we're experienced with the single family entitlement as well as in the construction management process. Now, we're not the GC ourselves, we're managing out the GC, but because of our experience in the construction industry, especially specifically for single family, having had that public home builder experience, we have what we believe is a competitive advantage that we can get deals managed faster and get better pricing if we do that. Now, we will buy anything from raw unentitled land that needs to be annexed into the city to already shovel-ready lots, but nothing of existing homes already placed on the site.
Well, the same follow-up that I had to Todd, then, do you buy those outright? Will you partner with landowners? And on the acquisitions, how do you finance those?
Yes, we will buy them outright. We will absolutely partner with landowners as well. We were trying to work on a big piece about 15, 20 minutes north of Nashville, and trying to figure out a way to partner with the landowner on that one as well. So there's a lot of ways we're willing and able to structure this deal and structure
part of
these
this competency, right? Is working with those landowners is part of that skill set you're probably talking about. How do you finance the acquisitions?
We have been primarily buying most of our acquisitions in equity and just straight in cash outright.
Another advantage with interest rates.
Yes. And we're looking, now that more deals are coming to our table, we're looking at using acquisition financing now in order to stretch our equity dollars a little more, despite the interest rates going up, just because we're seeing more deals that are able to potentially pencil. And so to be able to stretch that out a little bit, we're like, maybe it's actually time. Seems a little counterintuitive that interest rates are going up and that we're going to be placing down loans. But because of just the changing environment and other operators having dropped a lot of their deals, it's kind of time to hopefully be able to expand and get some as many of those as we can.
Brokers, local banks, where are you going to for the money for the
both debt brokers and local banks. A lot of the smaller deals that we're working with, so we will our target size deal is probably about 100 units. For deals that are smaller than that, it's really probably local regional banks are the best bet. But you get bigger than that, and then we're talking to our brokers for financing those deals, because those are the guys who are going to be able to leverage like the big institutional capital.
I know we have a lot of capital in the audience who are curious about that, so they'll be calling you after this.
Please do. You guys have my contact information, I hope. Any capital guys out there, any landowners who want to partner on their deals, give me a call, right? I am more than happy to talk to anybody.
I love the commercial. I got to go a different direction, Andy, because we didn't get this. I didn't think to ask it earlier, and I should have, of other developers. How long is it taking you to lease up a project? And has it changed in the last couple of months?
Well, as far as the project that we're working on right now, we're actually don't even have our first one ready for lease up, right? So startup mode, we're still under construction of that first one. But from what we're getting from feedback from our property managers and projections that we have for that, we don't expect there to be much difficulty in leasing these up. The build pace that we're targeting, and if we're building townhomes, it's a little bit faster than single family, but the build pace that we're targeting is anywhere from 6 to 10 units a month in terms of build pace. And what we're seeing just based on our feedback from our property managers and kind of initial feelers out there is that that is more than readily absorbed, that people are desperate for this product.
Yeah, I just feel like there's home runs waiting to happen. And maybe it's good that interest rates and inflation's happening, because it might mean that it's a little harder to get deals done, and there aren't, we don't just go nuts and build everywhere. So I'm excited for you guys that you have some competitive advantage, and that
Hey, Todd, speaking about building out everywhere, I know we got to switch up, but we got one question. What geographical markets does Andy at Pentagon look for from the audience?
We're building in the Southeast, so we're in Nashville and the Huntsville MSAs currently. By next year, we would like to be in Tampa, Jacksonville, and Greenville, South Carolina as kind of our next markets. And to Todd's point, the interest rates is just kind of a closing statement here. The interest rates are making it beneficial for the operators and the people who can stay the course and who haven't over leveraged themselves and who are managing their business well. I think a lot of people, there's going to be a lot of pain out there on the operator side for people who maybe have been a little bit too aggressive, but on the side of if you're managing your business the right way and you haven't been too overly aggressive, it's going to be good for you. I think going forward, for the demand side, obviously the renters, there's going to be more renters who are in a lot of pain. Unfortunately, people who otherwise would have been home buyers are now switching over to having to rent on the single family side. And that's not something that I say happily, honestly, even though it's probably good for the industry, it's good for our rents, it's good for rent growth, but it is difficult out there really for a lot of renters, for a lot of people in terms of affordability and trying to make sure and make the dollars meet in an inflationary environment and possibly a recessionary environment. So there's a lot of both tailwinds and headwinds on both of the operator side and for the tenant side that I think as long as people keep that in mind and try to build good communities, what we like to say is that we build good homes for good people. And it's kind of our slogan. So as long as you're building good homes for good people and you're staying connected to the people that you're trying to serve, I think that all of us are going to do quite well in the years ahead, despite all these difficulties. So thank you guys. Sorry, I went over a little longer.
No, you're good. I'm predicting 100% recession, Andy, by the way, because I've correctly predicted 15 of the last one interest rate increases.
That's pretty good. That's a pretty good track record.
All right, let's go over to Joel Kirstein. Thanks, Andy. Appreciate it. Good luck at Pentagon. I'm sure things will continue to go well for you.
All right.
Joel, give us a quick update, just a background on yourself and Berkadian, what's going on. And you and the three of us are going to kind of wrap up the whole thing. So I think we can go in a lot of directions, but let's just start with your background.
I think at a minimum, we can try to give everybody a couple minutes of their life back too. So we can increase the pace of talk here because I talk really fast. So we'll cover a lot of ground quickly, Todd. But thanks for having us on. I'm the national team lead for Berkadia's single family investment vertical, which obviously focuses a lot on the build to rent space. I've spent my entire real estate career in single family. And Berkadia as a whole, we've been in the industry about the same time as XF. We jumped in around 2012-13 in the Southwest, predominantly on our investment sales platform, and then have ramped there. We had a colleague of ours out of California named Tony Cinquini helped build the Freddie Mac pilot program with Freddie Mac for the scattered site permanent debt financing. And I would say to date, we're probably north of $3.5 to $3.75 of $1 billion worth of transactional volume, with probably $2 billion plus in active engagements right now. So also ramping up. We started really focusing on the investment sales side and then also how this would play out through the agencies. Tony did about 85% of that volume in a couple of transactions, and then they shut the pilot off. And so we pivoted as an organization, and I joined 5 years ago, about the time that they shut the pilot off. So I brought a bunch of clients over, and then Freddie Mac shut the pilot off. But we really started ramping up into the build to rent space. And now we do everything in the capital stack, from programmatic joint venture equity to preferred equity to construction financing to larger structured facility products. And then ultimately, although it's been a small amount, but ultimately a lot of this down the road, we believe will go agency, Fannie, Freddie, and we'll be a large player in that. We're the number one Freddie Mac lender in the country, number two Fannie. So for us, it's a long view, and being owned by Berkshire Hathaway Jefferies, privately held company, it allows us to kind of plan for the next 10 years in this industry and then build our teams and our presence in the marketplace accordingly.
Well, we have one of the things we haven't been able to touch on all day because we haven't had a lot of transaction people is cap rates. So normally if we've got a single family, I mean, I think if you looked at Pentagon where they were building single family for sale, you don't think about cap rates, right? Think about exit price for a house. When you've got a community, these things and they're rented, now you got cap rate. That's changed significantly, I have to assume, in the last 6 to 12 months. So what is the atmosphere for institutional buyers, institutional sellers, small buyers, small sellers?
Sure. I think number one is I'll try to create broad strokes here because I know you mentioned earlier we have a diverse audience attending. If anyone wants specifics to a localized market region, we have that data. We're happy to share it. Just reach out through Todd or reach out to me directly to get market specific. But we have seen cap rates move. And on average, I would say it's about a 50 basis points move up. And a lot of that has been predicated on the capital markets, right? The disruption that Evan talked about earlier. Cost of capital is more expensive. Whether you're an institution or a middle market investor, your debt costs you more. Warehouse lines, facility lines are costing more, lower leverage. And then the middle market sponsors are really starting to get squeezed because we've actually seen a flight to sponsorship quality. And so a lot of the middle market guys, there's not the same amount of products available today as there were 6 months ago. But generally speaking, we've seen those cap rate moves. And what's interesting is you look at the Southwest as an example. I can't remember who mentioned they lived down in there, but we had Todd Wood on earlier. We had our investment sales team selling stuff on performant cap rates 2 years out projected incomes, right? So if you think about trying to cap an income 2 years from now, that's where those deals were trading, on future income. Now we're seeing a pullback to really actually true underwriting, much like you normally would in a multifamily, where we're underwriting maybe trailing one or something like that on a stabilized deal. And cap rates yet have still moved out. And a lot of that is just because your cost of debt and the numbers don't make sense. And many sponsors are not willing to go into a negative leverage situation, hoping that rent growth will be there, because we all believe it'll continue to grow, but we also believe we're close to the top of that bell curve and then at some point it's going to peter back off. So do you really want to be upside down on your debt and on your leverage if, right, you've got a very tricky situation there. And so at the end of the day, we're starting to see that move, and we're finally starting to see sellers now come around. And you mentioned in our pre-call before this, were we seeing any retrades? Well, absolutely. Every deal was getting repriced for the most part. And now we're finally starting to see sellers realize that, hey, I could be catching a falling knife. It's probably better for me to transact with bird in the hand. I've got a group here. They're about to go hard. I'm still making a pretty good return on this investment, this exit. I'm just going to exit the position instead of thinking that in 4 months from now, this is all going to go away and my pricing is going to get better. So we're starting to see the market to normalize a little bit in terms of the bid and ask between buyers and sellers.
Yeah, I'm glad you brought up catching a falling knife. I told that to a group of young guys, young real estate people, and they looked at me like I was crazy. And I thought, you all have never been through this before.
Yeah, because their market, I don't know if this presents the right way, but it just goes like this, up, right? I mean, they've been in a market that's gone nothing but up for a decade. So, we had a blip with COVID and then it just bounced right back. So the reality of it is they haven't seen this. A lot of investors, and I think, I can't remember who mentioned it earlier, but on the development side, this is going to weed out a lot of the newer sponsors to the space because, again, they've developed only in an up market. When debt was cheap, permanent market debt was cheap for their buyers and for themselves. And now we've got volatility in the marketplace. It's going to weed out some of those middle market players that just were along for the ride, but really didn't have a formative exit strategy and understanding how the capital markets impacted that.
Joel, I wanted to follow up on, you just mentioned exit strategy. So that was a question I wanted to get to. Since this is such a new space, have you seen sales yet from developments that were developed as built to rent communities that have been developed and have sold?
So full cycle turn, so built,
Yeah.
stabilized, sell, yes. And we've been involved in a lot of transactions too that are also build, not stabilized and still sold. And even despite the volatility in the capital markets, we're still seeing a high level of interest from investors to take deals out at certificate of occupancy. So for those in the room not familiar with that terminology or what that means, effectively, I'm coming in as an institutional investor, and I'm going to take you out once you deliver that home. I will take up all the lease up risk. I will take all the management risk, but I'm going to do a purchase as soon as I can put a key in that door and start renting it. And we still have, I don't know, a dozen
For the
to
whole
15.
community, not just for the individual house.
Correct. And then it's phase, similar to how a home builder would phase lot sales, right? They open up phase one, they sell out of phase one, they open up phase two. So a lot of these forward contracts, they're called indoor takeout at CFO deals, are phased, where you might deliver 20 units and then there's a capital event. Maybe you deliver another 20 units in the capital event. I'm using that 20 as an arbitrary number. But there's still plenty of institutional investors that are doing that. And a lot of it is because it still allows them to control inventory faster. And they also believe they will do a better job of lease up and management, especially the lease up side, than allowing a developer who might have done it a couple times to lease it up. And lastly, those that are more creative on the capital stack and will do these CFO deals, they have less competition at that level. So they're not waiting for a stabilized where now you've got, 100 people signing a CA, 8 rounds of best and final, sealed bid. I mean, this is what was going on in Arizona, 2 rounds of sealed bid, and then eventually you have the right, or hey, you won, you got to pay a 3 cap on year 3 performing income. Boy, you should feel good. And I think to our comment earlier here, sometimes it's good to finish second, and we're seeing a lot of that now, right?
Right.
It was better to finish second on some of those deals because they've come back around.
Yeah, buy high, sell low is really easy. I mastered
Easy
that.
to say, hard to do when the market's
No, I mean, it's
ripping
easy.
and
It's
gets
easy to
2.5%.
it's easy to overpay. All you got to do is be the
Absolutely.
highest bidder.
And those developers that are selling, that developed and so full cycle sales, they're hitting home runs, which spurring more to get into the space.
I wouldn't say all of them are home runs, but I mean, the vast majority are good, solid doubles or better. I mean, again, if you look at the time of when they went to market, land positions, right, what land values have done, you're looking at 2-year ago land pricing in some cases.
And interest
right?
rates and construction costs.
Yeah, they've locked in at a low interest rate. They've locked in their GMP at a low cost. I mean, it's nearly impossible to get a GMP now. Most won't do it just because of the volatility, or within those structures of those deals, your equity is trying to tie the flow of equity to indices. So you might tie to a lumber index, and then if it floats up or down, similar like a floating interest rate, the equity's contribution as the JV partner will float up or down. So there's a lot of nuances that have happened in the structuring of these deals. But those that have hit the market prior to really 60 to 90 days ago they were mostly home runs, solid doubles at worst. I mean, everything just seemed to pencil out. And even in secondary, tertiary markets where you wouldn't believe the per unit pricing you're getting on some of these assets, $450 a door for a small MSA outside of Orlando, it doesn't necessarily make sense, but it does when you look at what is the cost to own, how much downstroke do I need, what does my credit score have to be, and the fact that my monthly wallet share, which is a big data metric we track and follow, is still less than purchasing the house, right? And I don't have to do anything, I just move in.
But it sounds like the last 2-3 months, we've hit stumbling blocks a little bit now. How do you see things going forward? Assuming a continued, 3/4 point here and there rise in rates, how do you see things going forward?
In terms of what? Sales activity, debt load, and just how do you see?
Yeah, I would say development activity, your loan activity, if it's going to shift to different products.
Yeah, you're just going to have to be more creative in structuring, and you're going to, frankly, if you have a pretty big cap stack, you should call somebody like, Evan or myself or a team like that is really in the market every day. Because again, what we do is we can leverage conversations across the country and size. So what I believe will happen is I think development will continue. There's a massive amount of development pipeline out there. We have some AI that we track development pipeline all across the country. So pick a market, Denver. We can go into Denver and within a pretty accurate stroke, 85% or better, pick up most, if not all, of the development projects. And we have not seen a massive decrease in the build to rent product. In fact, looking at John Burns, who was mentioned earlier, his data, all the build to rent operators have increased market share in finished lots, raw and entitled land across the board, their percentage of market share, and their percentage has gone up about 20 to 25% year over year in each category. So they're doubling down, right? And the publicly traded home builders have messaged that they're going to build through a recession by building rental. They're not going to hold the stuff or become operators. So development will go up. Now the question becomes, how do my deals pencil? And this is where, if you're a big institution, the deal pencils because you can just throw more equity at it, right? At some point, so long as you're hitting your minimum yields. Whereas if I'm a middle market operator and I've got to syndicate my equity, I've got to bring in a joint venture partner, I'm way more sensitive to the changes in debt markets because it affects the IRRs, and those IRRs are significantly more than a publicly traded REIT trying to hit a certain yield, just going, oh, okay, we can only do 60% of cost instead of 70. That said, there's still, I would say a large majority of our clients are institutional, but we do quite a bit of middle market sponsorship, and we're still able to help them execute on stretch senior loans, non-recourse, 80% of cost. We're still able to help them find, accretive cost of preferred equity that sits behind a local or regional bank. There's still capital structures that make sense, and ultimately then it just comes down to math in terms of what does that preferred return have to be, and what is that developer's return versus risk tolerance. So for example, I'll give you two barbells of two transactions. Right now we're capitalizing a very large portfolio in the Southeast. Total portfolio is probably 500 to 600 million in total capitalization. And that deal will look like a big institutional, potentially international equity source partnered with a very large money center bank doing a complex development facility loan. So I can cross collateralize all 5 of those developments into one loan. I'm done. I don't have to go to market again. Versus we're going to market on a build to rent project in Indiana, which is about a $12 million loan. Our team is. So we're covering both ends of the spectrum, but those two structures are
a pretty big spectrum.
Yeah, but it's a completely different.
Right.
And in our model is we've got a national team of which I sit on, and then we always have local regional experts involved in every transaction. So for us, it's a national team that parlays into that local expertise. I couldn't go in and capitalize a deal in Indiana off the top of my head for $12 million because it's probably a regional bank,
Right.
and most of them don't know who I am, right? So, but those both are getting done in this market despite the conditions.
Yeah, I worry about that middle market though, Joel. I think only from a perspective of we have a housing shortage. We've had it for a while. It's going to continue. And as things get worse, inflation goes up, hopefully not, but interest rates go up and the job market is what it is. We don't build enough product. It's going to be weird, but it could do real well for the developers that can still develop.
Yeah, and we need more good developers. I think and I agree with you, and I think the other thing that really, really parlays into that shortage though is we need like a municipality think tank. Like maybe you guys could host a conference for municipalities across the country and have people like Todd Wood and others come on and really talk about the space, because I can tell you, I transferred from the Chicago suburbs to Texas. In the western suburbs of Chicago, entitlement is very difficult, especially in the rental sector, because they still have this perception of kind of slumlord millionaire type renters, and they don't understand the difference between a 200 unit subdivision for sale that's managed by Tom and Becky on the HOA Association versus a 200 unit build to rent product managed by Todd Wood and his company. That's a massive difference, right? Or the core spaces folks, like massive difference in terms of quality of management. But from an entitlement standpoint, we hear a lot of developers have high level frustration still getting build to rent product entitled and pushed through because of the perception of the rental. And it just hasn't clicked yet. And my biggest concern, quite honestly, is the focal point in the choke here is the land component. And a large part of that land component is entitlements. And if you can't get them, the municipalities won't let them through. It's going to be really hard to build through that backlog, that housing shortage we have, right? That's a component that has to change.
Well, and you layer in construction costs and it gets kind of grim.
Yeah. Construction costs for sure.
Well,
Yeah, and we're seeing-
we ran up against our deadline.
Yeah.
Final thoughts, Joel?
Thanks for the time. I think this is great that you guys are out here and just really, again, bringing the news to the industry here. I think it's an infant industry still from a capital markets perspective. It's very immature. There's many of the life insurance companies aren't playing in the space yet. So I think that's a barometer. Once you see 75% adoption rate in the life insurance company space, then we're probably in the later innings, 6th, 7th, 8th inning of the cycle, but very, very few are on the debt side, very few are on the construction side. And, you know, I think it's an industry that, you know, I really like what Todd said. His biggest fear is really the pretenders coming into the industry. And we see it in our capital markets world too. There's guys who's rubber stamped themselves as single family experts because they did a couple of deals in a certain market. We can get rid of the pretenders in this industry. I think we have a really good opportunity to help it grow and also message it accordingly, right? And I know that's a big concern of a lot of our larger institutional clients, the household names that are getting beat up in the press right now is a lot of them. Interesting stat. One of the largest operators in the country, majority of their tenants could afford to buy a home and choose not to. Not that they can't, it's that they don't, right? And so I think as more of that data gets disseminated into the industry, we'll find that this is a viable way to attack the housing shortage. And I think one other last comment is this is where a lot of the innovation is happening. So we talked about different product and build types. One of the clients we're working with in Florida is doing a ESG net zero product built out of SIP panel construction, exterior walls and roofs. That type of, Lennar is doing a 3D printed subdivision in Austin, Texas. Like that type of innovation wasn't happening in the for sale market because it didn't have to, right? Public's biggest issue is backlog, not innovation. Innovation's happening in the build to rent space. And so I think this is very healthy for the housing dwelling unit industry because you have people able to do things like panelized construction, solar, high-tech properties, 3D printing. Like this is an area where you can do that innovation.
Well, Joel, that's why we're going to have these every 6 months instead of just once a year, because there's so much innovation. We feel like these people need to get together. We need to talk it out like we've done today. So
yeah, this has been great. We really appreciate you guys putting the effort in, and I like the format and appreciate the opportunity to be part of it.
Thank you. Thank you.
Thanks, Joel.
Great, Joel. Thank you for the time.
All right.
Thanks to my
Thanks, gentlemen.
co-host, Steve Bloom. Fantastic job, Steve, from LA.
Thanks, Todd. It's been
Todd
fun.
from
It's been
Minnesota.
great.
Thank you, everybody. Have a wonderful afternoon. This
Your
will be
feedback.
on YouTube. This will be on Steve's website, The Review. Do not forget about that. Send it to your friends.
We'll
You
start
can
seeing
send it
some
out.
info. I'm just send you guys info on the review, so you'll start seeing that.
Absolutely. And the slides and the other information will be available by rewatching the event, but also I'll make them available through our software. So that should answer all the questions we have. Feel free to reach out to myself or Steve or any of the speakers. I think they'd all be happy to continue to ask questions or answer questions.
Have a
Thank
great,
you.
profitable day, everybody.
Right on.
All right, Todd. Thanks.
Thank you.